Good morning. My name is I'm S.P. Kothare, and I'm the SEC's Chief Economist and Director of the Division of Economic and Risk Analysis. It's my distinct pleasure to invite all of you, or welcome you to today's conference on the state of our securities markets. Today's conference brings about a dozen experts from industry and government to discuss three broad topics. One, global macroeconomic trends, changes to the global equity and credit markets, and market concentration and fragmentation. I would like to thank each of today's participants for sharing their valuable time and wisdom with us. I would also like to thank the Chairman's Office, the Division of Economic and Risk Analysis, and the Office of Public Affairs for their help in planning and executing today's conference. Jeff Dinwoody and Jill Henderson were particularly instrumental in organizing the day's events. Before I begin my remarks, I need to mention that the views that I express today are my own and do not necessarily reflect the views of the Commission or its staff. And this applies to Dahlia Blas, who will follow me, as well as Jay Clayton, the chairman. Today's conference is set about a decade after what is often called the Great Recession. So today seems like a nice opportunity to reflect upon the current state of our securities markets. How are global macroeconomic trends affecting our capital markets? How do today's markets differ from those 10 or 20 years ago? What are the current risks in our securities markets? Before we turn to the program, I would like to say a few words about the topic itself, state of the markets. Naturally, any discussion would necessarily include a forward-looking element beyond a retrospective analysis. However, it is a notoriously difficult task of making predictions about the future. It's perhaps in the very nature of human condition to want to know about the future. For example, meteorologists predict weather, political scientists predict elections, and seismologists predict earthquakes. In all of these cases, the underlying models and techniques are not perfect, and the forecaster is often wrong. For example, we are all aware of the November 1948 headline that boldly reported Dewey defeats Truman. Are predictions any different in finance and economics? I think so. First, the set of professionals making predictions is larger. For example, there might be only a handful of professional meteorologists making weather forecasts in a large city, but there might be scores of, or even hundreds of investment professionals who analyze a particular mid-sized stock. Second, the rewards for making good predictions are larger. For example, the political scientist who correctly calls every election one year might get recognized on the front page of a national newspaper. But the investor who correctly calls investment decisions one year might retire early. Third, and perhaps most importantly, market participants affect outcomes. For example, one seismologist can ignore the predictions of all other seismologists because no earthquake prediction can causally affect the probability of an earthquake, but every investor needs to be mindful of the models of other investors. Why so? Because other trades can affect asset prices. In particular, investors' model not just a firm's discounted cash flow, but also market demand for firm's securities. This is akin to John Maynard Keynes' use of the beauty contest metaphor in saying, we devote our intelligence to anticipating what average opinion expects the average opinion to be. In the same vein, in addition to traders, policymakers also take into account the prevailing and anticipated economic conditions in formulating their policy responses, which in turn affect markets. Businesses, consumers, and traders all also factor in potential policy responses and their effects in making their own investment and consumption decisions. This is the essence of the eponymous Lucas critique developed by Nobel laureate Robert E. Lucas. For these and other reasons, I find the challenge of making market and macroeconomic predictions to be very exciting. Throughout my career, I have also enjoyed seeing the evolution of models in finance and economics, such as the efficient market hypothesis, the capital asset pricing model, and the Black-Scholes option pricing formula. These models and their underlying theories have caused paradigm shifts within our profession, yet I'm confident that we will continue to witness changes in the future. Unlike mathematicians who know how to calculate the exact area of a circle, and astronomers who know how to calculate the exact time of sunset, by the way, those who are interested, it's 4:46 p.m. tonight in DC. Okay. Financial economists will never reach that level of precision, but I do believe that we can develop better models and make better predictions if we better understand the past and the present. And that is the purpose of today's conference. So without further ado, let's proceed to the first item on today's agenda, a fireside chat on current global macroeconomic trends. And Dalia Blas, the director of the Division of Investment Management, will make the introductions. Thank you.
All right.
Good morning. I am pleased to be here today to join SP in welcoming you and to introduce our first panel, a fireside chat on current global macroeconomic trends affecting our capital markets. From my vantage point in regulating the asset management industry, there are really few topics as important as the one our distinguished panelists will be discussing this morning. Global macroeconomic trends have resulted in big changes in the asset management industry and more broadly in our capital markets. Both market participants and regulators are operating within a new and evolving landscape. One striking aspect of this landscape is the level of global debt, which now stands at approximately $250 trillion, or 320% of the world's GDP. In the United States alone, outstanding non-financial corporate debt is nearly $10 trillion and almost 50% of the US GDP. Now, the increase in debt is driven by various factors, and I'm sure the panel will be delving into that. For example, monetary easing by central banks has resulted in interest rates at historic lows. Further, global regulators have encouraged banks to hold highly liquid assets and less corporate debt, especially lower-rated debt. Combination of monetary policy and regulatory constraints on banks has contributed to a migration of debt investments from banks to other holders, including funds. In addition, direct household investments in debt have declined, with investments through funds accounting for some of that change. Our report from our Division of Economic and Risk Analysis summed this up with the following observation. From 2009 to 2016, the percentage of corporate and foreign bonds held by households decreased from 22% to 8.6%, while the percentage of corporate and foreign bonds held by funds increased from 8.5% to 18.3%. This shift makes it more critical than ever that we understand the connections between banks and non-banks, and from my perspective, banks and funds. These connections include exposure of banks to funds through both lines of credit and as counterparties in derivatives and other transactions, exposures of funds to banks through holdings of equity securities, overlaps in portfolio holdings, particularly holdings that are more susceptible to liquidity shocks, and clearing bank supply of balance sheet capacity to permit client clearing. Interconnectedness, leverage, and liquidity are all topics we have talked about for years, but the conversation should not be static and should be done with the evolving market in mind. There are a few other areas where the shifting landscape requires an adaptive regulatory approach. For example, increased globalization has intertwined domestic and foreign markets and policy considerations. This is why we at the SEC spend a great deal of time working with our international counterparts, including through organizations such as the FSB and IOSCO. Advances in technologies have enabled efficiencies and innovations in recent years. With that, however, comes heightened cyber risks, as well as new business models and products, including robo-advisors and digital assets. The growth and evolution in asset management industry has increased opportunities for investors. It also has given rise to public debates about concentration risks, common ownership, and the effects of index investing, to name a few. To be clear, observing the activities or risks have changed is not to offer an assessment on whether these changes are good or bad. That said, change does mean that market participants and regulators need to reevaluate risks continuously and make the necessary shifts in risk management and oversight. Recognizing change and modernizing oversight to meet that change will enable us here at the SEC to meet our mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. As regulators, I believe that we have to work harder and use all available tools more effectively in this changing landscape. We don't operate in a vacuum, of course, so one important tool is engagement with market participants. In that regard, events such as today's conference help keep us informed of market developments that impact our mission. Let me now turn to our distinguished panelists for their take on macroeconomic trends and how they affect the markets. Our chairman, Jay Clayton, will be joined by Gary Cohen, former director of the U.S. National Economic Council, and Glenn Hutchins, co-founder of Silver Lake Partners. The accomplishments of these individuals speak for themselves, and I will refer you to the program for their detailed bios. That said, I do want to note that this group brings unique perspectives and experience as global investors, advisors to governments and leading companies, crafters of public policy initiatives, and supporters of the study of markets. I'm sure you're going to appreciate their perspectives, and with that, please join me in welcoming our first panel.
Dahlia, thank you very much, and let me just extend on behalf of my colleagues here at the SEC, thanks to Gary and Glenn. We're going to talk about where the markets are.
I wasn't told I had any choice being here, Gary. How about you?
I'm in a similar camp.
Okay, good.
I wasn't going to admit it
just got an order
publicly.
from the
Wasn't
chairman.
going to admit it publicly.
So when the SEC calls, you still come?
Yes, yes.
Especially you, Jay.
Okay. Look, I couldn't think of two better people to give us an assessment of where we are and where we're going in terms of market function and the risks and opportunities we face. So just thank you both very much for being here. So let's get right into it. Glenn, you founded Silver Lake 2 decades ago, and you had a belief that the power of technology was underestimated, that it was going to transform our economy. How do you think technology is affecting our markets today? Where is it going to be 10 years from now? Your thoughts. I mean, this has been a driver of your investing philosophy for years.
Sure. So for people who don't know, I've invested. I was into fintech before fintech was cool, and investing at the intersection of financial services and technology for the last 20 plus years. I helped to build companies such as Ameritrade, the NASDAQ stock market, and now Virtu, which is a high frequency market maker. And I think the biggest thing that's the biggest thing that happened in financial services technology over that time period, and Gary and I had a conversation about this a couple of years ago, I recall, is when I first addressed these markets 20 years ago, the cost of trading was, for a retail investor, an eighth to a quarter plus a commission. Mm-hmm. And you waited, you made a phone call, you waited a couple hours to see if you got the trade, and then you settled 5 days later, wasn't it? Something like that.
Yep.
Now at Virtu and across the markets, we trade securities in microseconds, which is a millionth of a second. The binding constraint is literally how fast you can move electrons. That's the binding constraint on how fast you can trade. And at less spreads that are less than a penny. And that means that the cost of trading has been reduced by 99% or more over the course of that time period, and the speed is increased at an infinite level. And then for a whole bunch of other kind of reasons, we're moving, as we'll talk later on, and there's a new level of, we have the same capacity to make as big a transformation in the next 10 years as we had in those last 10 to 20 years, for a reason we'll get to later on. I think that's the biggest change, though.
That's the biggest change. Well, and look, Gary, through policy making and whatnot, you've been able to identify where conventional wisdom holds true and where conventional wisdom no longer holds true going forward. You know, technology, other areas, as you see government policy, where are we going where maybe technology is going to change conventional wisdom?
Well, look, I agree with everything Glenn just said on what technology has done to the markets today as we know them, as far as speed of execution, ease of execution. We still haven't figured the clearing thing out yet, Jay. We're still clearing like we move physical securities in horse and buggy, but we'll get to that later. I don't understand why we're not real-time clearing.
There's no technological constraint.
There's no technological constraint. There's other constraints. There's really no other constraints. We just need to start going to real-time clearing. When you talk about safety and soundness, that's a way to get safer and sounder. But when you think about where we are right now, and look, the United States has enjoyed an enviable position, being the dominant capital market in the world, both debt and equity. We've owned that position for a long period of time. We are on the fringe, and the fringe is important here. We're not in the middle. We're on the fringe of potentially losing that position. And I say that because the capital markets around the world are developing quite quickly in a much more digitized fashion than the US has developed. The US, although we've gone to high frequency trading, we've gone to digitized trading, we now see a lot of technology being used in other parts of the world, whether it's as simple as payments in China. And look, it's a lot easier to use payments in China, digital payments, because you have a relatively unregulated banking system. And I'm not espousing that we should go to an unregulated banking system at all. I think we have to do payments in a very regulated fashion, but we have to embrace that. We are now seeing digitization of more and more assets and more securities. I think that we have to embrace this digitalization. We can't say that everything's going to trade in the traditional way it's traded for the last 100 years, and this is our sandbox, and we're going to stay in this sandbox. So I think the fringes around the edges are starting to get clawed away. I still think that this is the dominant capital markets in the world, and it's sort of in the hands of the regulators right now to sort of lead, not follow. And I think you have an interesting opportunity to lead.
So you're telling me in a nice way, recognize this is happening and make it happen in the right way.
You said that, I didn't, but what I'm saying is, look, we've been so dominant for so long, we could always be the slowest moving animal and survive. I don't believe we can be the slowest moving animal and survive. The world's too big, the world's too global, there's too much money. We need to get in the middle of the pack. And right now, I don't believe we're in the middle of the pack in technological evolution of our marketplace.
So if you think about, one way to think about this is we've built out the internet over the course of my 25 years of investing around this stuff. First, we used it to create messaging, TCP/IP. Then we used it to create mail, SMTP. Then we used it to get to websites, HTTP. Actually, there was something called FTP in the middle, which allowed you to attach files. HTTP, TTP for websites, VoIP for voice. Now we're building it out for video. That's what all this streaming is all about, and all the investment is happening there. And the next thing is going to be value. And the question is, how can we use the internet to move anything of value at the speed of light at no cost, the way we've done all those other things that we've done? And to do that, we have to have a regulatory framework, like Gary's suggesting, that can keep up with that, rather than try to fit that new paradigm into an old regulatory paradigm. But also, we need to recognize that we have to adopt a technological leap forward, because the reason why the Chinese in particular, I've invested in some of these Chinese payment modalities as well, were able to do this is because they didn't have the credit card system with which to contend. Mm-hmm. It wasn't there, so they could go right, just like they skipped over landlines and went right to cellular, and a whole bunch of reasons why so they now pay, but even without fundamental technological innovation, the cost of payments in China is about 30 to 40% of what it is in the United States.
Yeah. Look, the message I'm receiving from you is safety and soundness, transparency, investor protection, all very important.
KYC, AML, audit trail, all important. But don't give up on those. But those can all happen in the digital world.
Actually,
the technology exists.
They happen much more easily.
Don't use yesterday's technology to achieve those goals. Use tomorrow's technology to achieve those goals.
Yes. Another way I look at this is, you look at, Glenn gave you an actually unbelievable tour of the internet in 30 seconds. I don't know how he did that without notes. But if you look at sort of the phone, which is where the world is right now, we went from landline to what I would call the brick phone. I mean, I remember my first cellular phone. You needed your own briefcase to carry it around, and you walked around with the brick phone. And then we went to the smaller phone. So we went to sort of the flip phone, and then we went to the smartphone, and now we're going to have to go to the secure phone. So that's the next part of it. And once we get to the secure phone, we're going to be able to use that secure phone for everything we need financially. And when I say we need to go to the secure phone, we're virtually at the secure phone line right now. And 5G, and we're at the edge right now.
Talk about 5G later if you'd like.
Yeah.
Keep going. You have
No,
more?
no, let's look. Message received on technology.
Okay.
But
Well, we can keep hammering on it.
No,
if you
no,
want.
I think it's.
No, but here, take a step back.
We can't let it pass us by.
Right.
Right. But we are already behind. In other words, the payments modalities in Asia are much better than they are in the United States. And this is not, but it's not primarily a regulatory problem. It's primarily a legacy issue associated with the credit card companies. Because the payments system in the United States is the only place I've seen in my career as a technology investor where the introduction of technology caused the price to go up. Usually, we've had these cost curves that drive prices down, like we talked about in securities trading. But in payments, they've gone up because Apple Pay adds a quarter, Stripe adds a quarter of a point, Square adds maybe even a point more. So payments go from 2% to 2.2 1/4 to 2.75. That's actually ripping off the consumer and making financial inclusion harder to accomplish rather than easier. And if you actually thought about the broader purpose of this kind of organization like this, you ought to actually be out there facilitating the introduction of technologies to take these prices down, to increase consumer fairness and expand financial inclusion. So I'd think about it that way.
No, I think, and to be clear, I'll give my usual disclaimer that my views are my own, and I'll also say I'm not going to pass views on any particular company. You guys are welcome to. But I will say the one thing we are devoted to here over our 85 years is that transparency in pricing benefits the consumer.
Absolutely.
And
Right.
that is clear. And to the extent technology enables us to provide transparency in pricing, it benefits investors and consumers. All right, so let's shift from technology.
We're not going to shift. It's going to keep coming back in every answer. Okay, just so you know.
I've never, ever been able to control Gary Cohn. Okay, monetary policy. Now, I know you have a disclaimer.
Right.
You're a board member at the New York Fed, and your views here are your own, not those of...
Don't worry, they don't listen to me either, so don't worry.
But we've had a run of accommodative monetary policy, probably the longest run in history. Effects, how we should look at that, where do you think we're going? I believe it's driven some changes in the market, but including, as Dahlia outlined in her introduction, a shift to more debt, and due to some other regulatory events, a shift in debt from debt being held by banks to being held in our capital markets. But your thoughts?
So I think the thing that most concerns me as an investor in this space, an investor in this moment, is that these very low nominal interest rates, we can come back to what real interest rates really are later, but these very low nominal interest rates cause every layer of the risk structure to search for yield. So people who would normally have bank deposits buy treasuries, people who would normally buy treasuries buy corporates, corporate buyers go to high yield buyers go to equity buyers go to illiquids. The people who are normally in the illiquid space take on more debt and go to late stage growth, and the whole layering of risk involves with people reaching for yield and taking risks that they're not accustomed to taking or not professional at managing. And then when that reverses itself, it has the risk of reversing itself rapidly in a way that's reasonably predictable. So that's my biggest concern about how the markets are operating right now. We can get into what that means in each of those segments.
But actually, let me tee this up for Gary this way. There are some people that believe we're in a lower for longer, and then there are some people who believe that a snapback. How do we get to somewhere in the middle?
Can I make one comment before you say that? One of my rules of investing is widespread capitulation is the first sign of the bottom. So as soon as people say interest rates are going to stay lower for a very long time period, that's when you ought to be prepared for them starting to go back up again.
Glenn, I've been saying lower for longer for 5 years, just so you know.
That's low.
I remember,
Right, go ahead.
if you remember back 5, 6, 7 years ago, we were talking about interest rates in the economy, and we were using letters of the alphabet. We were talking about V-shaped, U-shaped,
Right.
J-shaped, and I said, think of L-shaped.
Right.
Okay, so I've been saying it for 5+ years. But Jay, I think you almost have to back up here. It's almost difficult to answer this question without saying, how did we get here? And I won't drone on how we got here, but you've got to go back to 2008. You've got to go back to the financial crisis. You have to understand that central banks around the world, in a coordinated effort, basically decided, and justifiably, I'm not saying they did anything wrong, justifiably decided to flood the system with as much possible liquidity as they could, and threw every dollar, yen, sterling, euro, anything they could at the system. And they literally put it in the system, and they put it in, and they wanted to stimulate growth, and they wanted to make currency available as cheap as possible. They also did that simultaneously with the two big saving economies aging into that older population, where Germany and Japan, they're not going to spend the money no matter what. We've already proven you can put negative interest rates out and they won't take the money out of the bank. And so this idea that we can get savers to become spenders because we send a negative influence by taking rates negative, we've proven that if you're a saver, you're a saver. If you're a spender, you're a spender. We could say the same thing in the United States. We could probably make interest rates 10% and people wouldn't save. In Japan, you can make rates negative and they won't spend. So we started with this whole issue of creating global liquidity. We're now at the sort of 10 years from the other side of that pendulum, where 08, 09, flood the markets with liquidity, lower interest rate, ease. And now we're trying to figure out, okay, we really haven't created growth out of that easing policy. We have not stimulated the way we wanted to stimulate. How do we stimulate from here? Negative interest rates, and this is a personal opinion, or I guess all these are personal opinions, have this very negative unintended consequences, especially as you have aging populations, and they dissuade savings, which is exactly the wrong thing to dissuade, and they make people on fixed incomes more financially insecure, not more secure. So now we're in this part of the equation where we're trying to say, okay, what should we do? How should we do it? How do we get the economy growing? We've proven that sort of throwing money at the situation doesn't just create growth in the world. And a lot of this, I believe, happens to simultaneously go with a lot of the regulation that happened after 08, and the fact that the world has become more and more globalized. And so one obvious example I'll use, since we're at the SEC, I'll talk about a financial service example. You look at the financial services industry in 08. The regulation that was forced upon financial services industry was so enormous that every financial service company, basically in the large asset managers down to every bank, was forced to add enormous amount of regulatory cost to their system, but they couldn't afford that regulatory cost. So they all of a sudden figured out, if we can export labor to cheaper markets and arbitrage labor cost, we can then afford to be in this system. So lo and behold, Bangalore, a city where I couldn't have found on a map 15 years ago, now is a city with millions and millions of financial services jobs, where we can hire someone for $35,000 a year doing the same job that someone in New York would do at $135,000 a year. So we've created this labor arbitrage market that we all got very smart to in the world. And once Bangalore got to $40,000, because we were hiring everyone, we found the Philippines, or we found Poland, or we found all these other markets. And because of necessity, we've now created this global labor market where you just keep finding cheaper and cheaper labor. And when you find cheaper and cheaper labor, you don't have wage inflation to the extent you want wage inflation. You don't have any inflation in the system. So in a lot of reasons, throwing money at the situation and regulating the situation just forced people to get a lot more creative on the situation. So, in my opinion, we almost have to figure out a way to start withdrawing the liquidity from the system. And it's going to be a slow, long slog. And in many respects, the Fed tried to do that. They tried to cut their balance sheet down. They tried to go through a very slow process of retiring their balance sheet. And these are the right steps to go back to what we would consider a normalized environment.
Yeah. Now, Gary touched on some things. I'm going to do a little bit of a segue here, but I know it's an area you know a lot about. The way the macro economy operates today. We touched on technology. Gary's talking about availability of labor being a global issue. We know capital moves faster. We know supply chains are real time. Glenn, are we measuring technology and the effects of technology in the right way when we make policy?
This is a very good question. So if we were sitting here 2 years ago, roughly, and we started talking about Fed policy, we would have all assumed that we're heading towards something called normalization, which was basically rates are going to go up, the balance sheets are going to go down, and we're going to be to a place where it looks more normal relative to historical experiences, and there's what's called policy room. So then when the next recession comes, you can drop rates, you can expand the balance sheet, you can do it all over again. And we sit here 2 years later, and the markets couldn't digest that. Right, the little bit of rate increase had not just market effects, but also real economic effects. And recently, as the balance sheet was being shrunk, the repo markets are sending signals that there's not enough liquidity out in the system. So what's wrong? What do we? So you look at that and you say, what don't we understand? And as Gary suggested earlier, I think today you have to extrude every question through this dimension of what is the impact of the transition we're on, the fundamental historic transition we have from the industrial to the information economy, and what aren't we understanding well? So let's think of, and one of the things people are telling us, is economists tell us, is the reason why we haven't got good growth, economists tell us, is demographics and low productivity growth. That's the answer in the numbers. Right? I mean, you talked about some of the demographic trends earlier, but it strikes me as unlikely that we are experiencing low productivity growth during the information revolution. In fact, it strikes me that we have enormous productivity growth, which we're not measuring. Do an experiment one day, if you have a few minutes. Put 2 columns on a piece of paper and put on what you pay for everything on this device, and then put in the other column what you used to pay for all the things you bought that this device now does for you. And I stopped when I got $1,000 on one side of the page and $20,000 on the other. This is the greatest deflationary tool I've ever experienced. So if you think about it, maybe we're not measuring productivity correctly. If we aren't measuring productivity correctly, perhaps that means that the economy is growing more rapidly than we think, and we're not really measuring it well. And if that's the case, the math means that we're actually in deflationary times rather than inflationary, modest inflationary times. So let's just take a number. If we're actually experiencing 2% deflation rather than 1.5 to 1.7% inflation, then real interest rates at about 1.7% 10-year are more like 370 basis points, which is about the historical average for real interest rates. And so and if you imagine that we're at the normal average for real interest rates, the economy is behaving almost exactly the way you would expect it to as you try to increase interest rates in that time period. So it could well be that we're not measuring the economy correctly as a consequence of which not understanding the effect of the policies that we're applying, and as a consequence of which aren't really thinking about the right policy mix. Sound right?
Yeah, no, I don't disagree with that.
It's just hypothesis. I'm not saying that's the case.
In the U.S. economy,
It's a different lens.
It's a different lens.
It's a different lens, but it provides some insight. I mean,
right. It's a different lens. And remember, our economy in some respects gets harder and harder to measure as we become a dominant service economy. You know, we're 80% service economy, GDP and jobs in the United States. So we're not measuring our economy on how many cars and how many machines and how many airplanes we put out. We're measuring our economy based on how many people are going to get Starbucks coffee and how many people are going to the dry cleaners, and how many people are going to the nail salon, and how many people are going out to dinner. I mean, that's really our economy, and how many people are buying banking services and accounting services, and the big poise is how many people are buying our technology and technology products, and are they actually paying for our technology and technology products? But maybe we'll get into that, or maybe we won't get into that later.
And if the price of one of the things goes down, that's less GDP.
It's less GDP. And so like airplane transport, air travel in itself
Right.
is one of the very deflationary things. You know, like price of an airplane ticket, price of computing power, Moore's Law, all these things become very deflationary. And as higher end retail stores selling things have moved out of inner cities and more service businesses have moved in, the marginal rate for rent they're willing to pay is less than someone selling goods. So rents have come down a little bit. So retail space is worth less today, but you're employing more people at different wage levels. So a lot of what Glenn is saying resonates with me. That we're just we're trying to use 20 and 30-year-old isolated domestic U.S. measures in a globalized world.
Yeah, older, more domestic than global.
Yeah.
We need to look at where we are today. And I do want to, before we shift to technology, because I want to get
We're
back
shifting to technology?
shifting.
Just kidding.
No, I love it. I love it. The discussion we had about more credit being in the capital markets versus in the banks. How should we be thinking about that?
That's Gary's world.
So look, this is one of these issues that sort of irks me, because getting it out of the banks is probably the right place. I mean, financial crisis of 2008 was the bank's balance sheets over-levered with credit. When you get it into the capital markets or into the asset managers or into the consumer, all those asset managers and all those other places are basically the consumer. This great idea that U.S. citizens don't own credit and U.S. citizens don't own equities is really kind of interesting, because, you know, back in my good old days when I used to work for a living, you know, when we sold stock and we sold bonds, our biggest buyers were the pension funds from the teachers' unions and the police unions and all those things. I thought those were just normal people, and so they actually own those assets. So we were disseminating those assets into what I would call retail America. The question to me is not who owns those assets. I mean, it's really not who owns those assets. The question to me is how much leverage is there behind those assets? Because that's what ultimately comes down to the whole financial crisis, the whole stability and safety and soundness of the system, is if there are hedge funds owning those assets or there are asset managers owning those assets and they're paid in full, there's no issue, there's no problem. The only problem is they can go down in value, but look, there's ways, that's what happens. Markets go up, markets go down. To the extent that they're leveraging them and they're being provided a lot of leverage through the banking system ultimately owns the risk anyways. Because the banking system can ultimately, you know, if the ultimate owner defaults or can't repay them because they're over levered on their credit portfolio, the banking system bears the brunt of it. So to me, that's the question, Jay. And I think based on where we are on the regulation that we have today, and this is one place where regulation works, where the banks are stress tested, and they go through their CCAR and they go through all of their testing with the Fed, I don't think the banks are over-levered and extending credit to people that own credit today.
Okay. And so, yeah,
I was going to say two things. You guys might disagree with this, but I think first thing we want to do is, I think, understand history correctly, which was, it was really the securities firms, not the quote-unquote banks, that were the ones that failed and got into trouble.
Well, thank you for saying that, but that would have been self-fulfilling for me to say.
Just so we know, right? It was Lehman Brothers and Bear Stearns and maybe some thrifts.
Oh, I was a security firm back then.
Yeah, you were a security firm back then.
Well, until Sunday, then I was a bank.
And the solution was for you to become a bank.
Right.
So it wasn't quote unquote the banks that failed. Yeah. It was the securities firms that were doing maturity transformation. So if you had deposits, you were in pretty good shape.
I agree.
It was the securities firms that were borrowing short and lending long, and accumulating, in many cases, bridging things before they could securitize them. And it was also money funds doing a very similar thing as I talked about earlier, maturity, sort of reaching for yield, that were kind of, supposed to have, short-term securities. We're buying slightly longer-term securities in order to kind of get more yield. And so what I would do is I'm really trying to understand kind of where the risks are in the system. It's really where people are doing maturity transformation, which is what the economists call borrowing short and lending long. And so I'd look for that through the system. So you mentioned something we were talking earlier about where the leverage is. In other words, I'd be less concerned about a private equity a credit private equity fund that's got commitments of capital for 10 years with 2 one-year extensions, so it's 12-year money. They're out buying high-yield debt in the markets, and that debt might go up, might go down. It might have to be marked to market. They might have some bad reports, but there's no capacity for the investors to say, I want my money back. The big problem that happened in the financial crisis was there was this massive capital call all across the economy. Everybody said, I want my money back. I want to sell my securities in order to cover my obligations. And that's the place where I would look and make sure that there wasn't a problem. So it would be leverage inside these companies, short-term leverage inside these companies that are lending long by buying long-term credit-based assets. That's where I'd be concerned.
And are subject to liquidity stress.
Yeah, exactly. Yeah. Exactly. That's borrowing short.
Yeah.
Yep.
Whereas the lender can say, I want my money back.
Duration mismatch. Sure.
Yeah, exactly.
And we should always be looking for duration.
I agree.
mismatch.
Duration
the place to
mismatch
look.
is. We saw one of those this year.
But I think there's something I do worry about a little bit that is out there, and it's less this issue, but it's more because the problem always comes from where the bubble is. And the bubble right now, one of the bubbles in the world right now looks to me by this massive movement of money toward index funds. That's been the biggest thing that's happened post the crisis. So I'd take a very good look inside that and see what the ramifications were of that reversing itself in some important way, because that's the biggest transformation in flow of funds that's happened, other than what's going on in the Chinese banking system, which is a whole different kind of thing. That's happened since the financial crisis. That's the part that I look at and wonder about, what the implications of it are.
Yeah, let me give you one data point that I ask people, and I think this is an appropriate forum to say that I ask people this, about indexation. I often say to companies, well, if it's kind of a passive strategy, how much would a company pay to be in a very popular index? I think the answer is a lot.
A lot.
So, tells you something, right? I mean,
well, look, I can give you some relative values that, so it used to be, and I'm dating myself now, you got announced that you were added to the Dow. I think that was like, we're 7 to 12% of the value of your stock, back in the days when we used to do big index rebalances. And, the movement on any day when a stock would go in or out of a bigger index, would be anywhere between 2 and 12%.
And you guys are investors, you know this better than I do, but that means your cost of capital is actually goes down, right?
Yeah.
So
Yeah.
Oh, sure.
it's got value.
It's got a lot of value.
Nothing happened in the company
Pay a lot for
except
that.
more people were forced to own the security. Now, the contrary happens when you come out of an index. Okay.
Right. But the thing, if you're heading toward kind of where's the risk in the system one should be worried about, can I expand on that just a little bit?
Please.
Mind about that? I think the two places that we're paying insufficient attention to the risks of the capital markets is climate change and cyber risk. And with respect to climate change, Mark Carney, the head of the Bank of England, has spoken, I think, very intelligently about that there's a potential risk in the insurance markets in London, which are a very important part of the financial system in London, to the cost of the growing insurance claims for climate change related kind of issues. And so I would say that from your perspective, I would say making sure that companies are adequately disclosing their exposure to climate change and the risk in their businesses associated with that is very important. And with respect to cyber risk, I think the potential next financial crisis is more likely to come down that dimension than the dimension of sort of maturity transformation. There's a book I think everybody should read called The Perfect Weapon. I know you have it. I think I gave it to you. And which is about the last 8 years of cyber competition among nations. And the author, who's a Pulitzer Prize winning New York Times reporter, hypothesizes in the last chapter what the next war could look like. And it would start with our adversary turning off our electrical grid and our financial system, and then telling us to surrender before they attack without firing a shot. And the vulnerability of our financial system to cyber, almost every one of them has been intruded upon. If any company out there or bank tells you they haven't been intruded upon, they're not telling you the truth. All of them have been intruded upon. All of them are vulnerable, and being able to kind of put up those defenses and understand their financial soundness implications is very important.
Yeah, I think what I can say is this is an ongoing conversation. It's a very important conversation. My view is the conversation has matured to some extent. We're now talking about resiliency as opposed to defenses. When something happens, how do we recover? I think that kind of conversation needs to go on. I also think, let me just say, the liquidity issues we talked about, as history shows us, there's usually a catalyst that drives those.
Yeah, that's a good point.
And I could see technology being that kind of catalyst.
Right.
I hope that our investors and consumers understand that we will have technology issues. They will happen.
Yep.
The question is how we deal with them. Are we prepared? Do we have the resiliency? Can we move forward? But that's a good shift. Crypto assets. What do we think about crypto assets? I mean,
You have a problem with your left hand today?
Go ahead. For once, you're to the left of me.
So, yeah. Wow, it's hard to get to the left of you. Crypto assets. So look, I think you got to break this down because we conflate crypto and blockchain in America. We think they're synonyms. They're not at all synonyms. So I will be pretty quick on crypto. I am not a real believer in sort of the cryptocurrency world. Glenn may vehemently disagree with me on this, but I am much more of someone that thinks in the United States, we still believe in safety and soundness. We believe in KYC, we believe in AML, we believe in audit trail and some regulatory oversight. And in the crypto assets that are out there are sort of the antithesis of that. So to me, they are going to be tough assets in the United States. That said, so take the currency side of it out. The technological side of it is unbelievably important and is going to be part of a huge evolution that's revolutionary in our business. And you're already starting to see what the blockchain can do and how the blockchain can be used in all industries, but it is extraordinarily relevant in financial services, in consumer credit, in areas where we as a financial service country, we as a capital markets country, we'll use it day in and day out, and I think it will have enormous impact across the entire spectrum. I think if you're not thinking about it really broadly when it comes to financial services, you're missing enormous opportunities, and there are enormous amount of companies out there in each of these little silos trying to perfect and figure out exactly how they make it work, and it's really kind of simple. And Glenn got on this topic, and I'll just elaborate on it for a minute. This old idea that we created all these data warehouses and we kept all this important information on individuals and on their creditworthiness and on their financial information, we kept it in data warehouses. Well, that was cutting edge technology when it was built. But the bad people out in the world, they knew those warehouses existed, so if you wanted that information, you might as well go to the place where all that information is stored. That's why people rob banks, because that's where the money is. If you're looking to steal identities, you go to the place where all the identities are held. In the blockchain world, you can get rid of all of those data warehouses. You can create the identity real time, instantaneously, have it created, and then have it disappear. And so think of the ability to create things on a real-time basis as you need them, use them, and then have them go away, and you can get real-time information, not the information that was sent to the warehouse. So there's just enormous amount of applications for this, and whether it's digitizing securities, moving securities, fragmenting securities, it just has enormous use. So I am very, very bullish on what it's going to do to the industry, and this goes back to where we started, how the SEC, the CFTC, the Fed, they're going to have to understand that this is going to happen with or without you, and it's better off to happen with you.
Okay, a couple things. All that is accurate. Let me just give us a different, slightly different perspective on it. Let's talk first about digital currencies, and let's talk about crypto stuff. Digital currencies today, roughly 92% of all currencies in the world is digitized.
You're talking about fiat versus crypto?
Just currency.
All right, so break them up though. So look, I totally believe in digital fiat.
Yeah, that's
so
right.
Digital dollars, digital yen, digital euros. I don't. Those aren't crypto to me.
That's right.
That's digital fiat. So I just want everyone to understand that we're probably in more agreement.
No, not agreement. I'm just saying. Okay. I'm sort of dividing these two things apart,
Fine.
just like you just did. So the first thing you have to understand is that moving to a digital currency is a very straightforward thing to do. People call them, and the two things can interact, of course. Some people call them stable coins. Some people call them, the Chinese are working on their own. Taking that thing on paper and turning it into a digitized thing is a very straightforward thing to do, and today, the vast majority of money in the world is already digital because it's just electronic entries at banks and central banks.
Yep.
So the notion that it's some big revolutionary thing, I can take 8%. By the way, Ken Rogoff's book, The End of Cash, says that the 80 to 90% of US $100 bills are used in organized crime and tax evasion. So the thing that's most useful to the bad guys is cash. It's the ultimate sort of anonymized security. But anyway, so that's a straightforward, easy thing to do. It should be done, and we just got to get there.
Agreed.
Right. That's easy.
Amen.
Now, if you talk about the whole crypto kind of world, I got to this from the kind of the payments thing because I've been looking for a way in which we could take the cost of payments down by 99%, the way we've taken down the cost of trading in securities. In the payments world, we use the term, we oftentimes use the term of the payments rails. There's the credit card rails, there's checking rails, there's the FedWire rails. Moves around. So let's to understand how I think to think about the cryptocurrency world is there are three parts of it: the blockchain, the token, and the protocol. And the three of them operate together to create one solution, one integrated solution that has the capacity to revolutionize the way we move things of value around the world. Let me use a railroad analogy to make the point. The token is the equivalent of the boxcar. It's the thing into which you embed something of digital value that needs to be moved from one place to another, from one part of a blockchain to another. The blockchain is the cargo invoice, is the invoice in the cargo manifest. And the rails is the protocol. And you have to think about all three as one integrated solution that enables you to accomplish the purpose of moving anything of value around the world at the speed of light at no cost, the way we talk about email today. People who just talk about blockchain are talking about something very interesting, but it's a piece of enterprise technology that's an advanced database, and a private blockchain unconnected to the global, to the Bitcoin or another digital currency blockchain is the equivalent of the intranet. Mm-hmm. Remember when we had intranets to begin with, where it was really cool, you could do internal communication with people in your own companies, but it wasn't really until those intranets were connected via the internet protocol to other intranets to create the World Wide Web of intranets called the internet that the world changed. The world is going to change in finance when we connect the private blockchains via the Bitcoin or Ethereum or other protocol to the other blockchains in the world, have a global blockchain that's the World Wide Web of blockchains that'll fundamentally change the way in which not only do we move value around the world at the speed of light, but also in which we actually fundamentally change the way in which we compute, because it's the fourth computing paradigm I've experienced in my lifetime, the decentralized computing paradigm. That is the vision of where we can really go with this that's transformational. Now, the first step will be the intranets, the blockchains, as those get deployed. But that's not the end point, that's just a first step. And go into all that stuff at greater length if you'd like me to, but that's a beginning.
No, look, transformative. I want to go back to something we talked about around monetary policy, which is if this happens, which I think I say if, I think you're saying when. I get it.
You have a little bit more to do with the if than we do, I'm just kidding.
No, and look, Jay, my view is it's happening.
Yeah.
What is the U.S.'s role?
Right.
Yeah.
Well, that's where
Yeah.
that's
Right.
I'm gonna go
Good
further
point.
because
Do my right hand. Yes, you're right.
because we're both involved in companies that are doing it. We'd like to do it here, but we're gonna do it.
Well, let me ask this back to what we were talking about, measuring things in our global economy. This also sounds incredibly deflationary because of the costs that will be driven out of our system. Agree, disagree? I mean, if we're going from paying a percent on a retail basis, 2%, 3% to move things around to virtually nothing.
Well, let's maybe the nomenclature is important. Deflation is not necessarily a bad thing.
People need to understand that. If it's cost savings,
if my being able to buy something
it's
at a
just
lower
part
price,
of the dual mandate. That's where the problem is.
right, exactly. Right.
No, but let me say,
But
if
the
those,
mandate is about real interest rates.
Yeah.
let me put this at a U.S.
But Jay, the question is, who pays? This is
that's where I'm going.
okay. All right, then
Yeah.
ask your question.
My question: You want to
See how nice a guest I
you
am?
want to be in the position where you've introduced this cost savings across the globe. You don't want to be a taker. You want to be somebody who leads in this area. Is I think what you're saying. Because we now do have a global economy, and these savings are global. You want to be a leader. Look, been a leader in many things.
Agree.
So
look, the issue is in Glenn and I haven't talked about this before. It's interesting. We're having our first conversation on us both attacking sort of the same problem. The friction in the payment system is huge. It's not seen by the consuming public. It takes away from their purchasing power because they just pay the marked price. But the seller, the retailer, gets 97 or 96 or 98 cents on the dollar when they go turn in their credit card receipts or their payment receipts. They just know they're getting less than par every time they sell you something in a store. If the retail seller could get par, this is the interesting question, would the prices come down 2 or 3%? We don't know the answer. But someone eventually would probably figure that out. With the amount of technology and digital sales and digital outlets, you know it will happen. It takes one first mover.
the power of shopping is unbelievable. Once people can see prices and shop, prices
Exactly
come down.
right. The market has become pretty efficient, pretty transparent. And there are a bunch of companies out there that will basically take your grocery list today and put it in the computer and tell you what grocery store in your neighborhood to go to where your all-in grocery list will be the cheapest. And so you'll get more and more evolution on this space.
All right. Well, any last thoughts on this space? I think this has been a tutorial that
I just think that we ought to come back to, at the end, consumer welfare, because that's kind of what we're after, right? And that's not necessarily measured in prices. It's not necessarily measured in productivity. It's not necessarily measured in GDP growth or inflation. But the extent that you are offering something to a consumer that's better, faster, and cheaper than what they had before, that's a good thing.
Yep.
And the way we add it up on our economy and talk about it needs to be subsidiary to that insight. And policy needs to address the change, needs to be able, just like we talked about with crypto, just like we talked about now with Fed policy, it needs to change what tools it uses, how it addresses that based upon how the economy changes in the pursuit of greater consumer welfare, rather than try to use old tools and old frames of reference old lenses to understand the modern economy.
So look, on the consumer policy side, I will add one thing that I think is important. Glenn's talked about a couple of the major problems in the world, whether it be climate or things like that. There's another issue on social side. We all talk about banking the unbanked. A big problem. The payday lender should not exist in America today. It's one of those things that when I drive by them in New York City and see payday lenders, it's kind of shocking to me. In a digitized dollar, stable token, whatever you want to call it, world, we would eliminate payday lending. That has to be stimulative to the US economy. Because if you could basically get your paycheck into a digitized wallet or into a stable token, take that wallet to any ATM, even if you pay the $2.50 ATM fee or pay the $4 ATM fee, I don't care what you know, versus paying 10 or 12 or 15 or 18% to a payday lender to get your money into your pocket or use your digital wallet at point of sale, you're adding a huge amount of disposable income back into the system. And to me, that is one of the huge potential opportunities and windfalls that comes out of this technology.
And it has to be consistent with the SEC's specific mandate and the government's broader mandate of consumer welfare, social justice, and financial inclusion.
Yeah.
Right.
Let me make
and so thinking about it from that perspective is something we ought to go make sure gets done, as opposed to put impediments in the way of it getting done.
Then one more quick thing. Then you get to what Glenn said about the $100 bills. If you literally could get to a cashless society, you would basically have a society where your income taxes would become digitized. You basically would almost push a button at the end of the year. Everything would go in the system, and you'd hit calc. Or you could hit calc every day and see, and you could end up in a real-time tax society. There'd be no fraud, there'd be no anything in the world. You would have everything go through the system. And then this whole fraud and lack of collection of taxes, people say 30% of our taxes in the United States don't get collected. That's the problem. I don't know if it's true or not, but we can fix it.
But the other thing, and the last thing I would make point you guys understand is that you talk to law enforcement people who have actually spent time trying to track. Why did all the Bitcoin guys get caught? Because the public blockchain is a permanent, unauditable record available to law enforcement. Right? So there's actually a whole law. One of the ways in which you get rid of fraud is that the public blockchain is out there for everybody to see, and the community is the one who validates every transaction. So you can go find exactly who did what when.
One of the things,
So it's very important.
Public service announcement for my colleagues here at the SEC, the women and men. Investor education is so important to us.
Right.
Investor education becomes a lot easier when you get rid of opacity and complexity.
Mm-hmm.
Yes.
When people can see what they're paying. I often say, in our economy, there are people who pay 8 to 18%, and there are people who collect 8 to 18%. You want to transition from being the borrower at 8 to 18 and as close to 8, not 18 as you can, to the person who's getting those returns over the course of your lifetime.
Yes.
We are trying to help people understand that. And to the extent technology helps people understand that, it's a wonderful thing.
See, I want to do something entirely different, right? Which is I want to get rid of that. In other words, that's just a cost in the system that is an inefficiency that needs to go away. Right?
I agree with Glenn.
Right.
We can get rid of those 8 to 18%.
That's just like the 8.25 plus a commission. It's just like doesn't have to be there for the markets to operate. Anyway, so go ahead.
By the way, but the funny thing is, at the time we had it, you couldn't imagine it ever going away.
Right.
But we are now at a place where we can get rid of that 8 to 18%. And I can not only can I imagine, I can see it.
You need a set of economic constructs in which not that one person gets it versus another person getting it, with which it's irrelevant.
Yeah, I agree.
All right, last topic. What's going on today? Brexit, trade, markets. What do we think about markets today? Any comments from either of you?
That was your right hand. I saw
That's
that.
what
Was a
I'm
right. That was a right
yeah,
hand gesture, not a left hand gesture. So look, that's a how long is a piece of string question. So Brexit. Look, Brexit comes down to an election, right? And we're on a very short time frame here. If Boris wins, which I guess is the polling now, he's got sort of end of December to notify the EU he's leaving. I assume he does that. Let me give you a more sophisticated answer than that. It looks like he's polling at a high enough margin to get a majority government, but right on the edge. I assume he would notify the union he's leaving. He's got a year basically to leave, and he can extend a couple of years. So I think that's sort of where we end up. So it's a I guess people call that a quasi-hard Brexit. Which to me, I've said this before, it's probably the right answer. We just can't keep living in the world of the unknown in Europe. It's probably the best thing that could happen. We'd stop talking about what is going to happen and what could happen in the future. I think it will be fine. The whole thing is, what do we do with trade agreements? How do we keep airplanes taking off from the United States to Europe, and trade agreements? And most likely what will happen is we'll just take the existing trade agreement, we'll re-sign it, and keep extending it out for 6 or 12 months at a time until we can renegotiate new trade agreements, but it will take years. So, I think the UK election, well, I know it will come and go, and there'll be a winner, and if that happens, if we end up with a surprise on the other side, we'll just live in this turmoil like we have been living for multiple years. Someone last night, I was in an event, they said, the bid offer is parity on sterling and 145 on the upside. So we're somewhere between parity and 145. The U.S. to me, we're in an interesting spot here in many respects, because the consumer continues to do what they're really good at in the United States. They're really good at spending money. Like I said, it doesn't matter what interest rates are in the United States, the consumer here knows how to spend. The consumer we're at 3% wage growth. They're taking their 3% wage growth and spending it. They're taking their tax savings, to the extent they got tax savings, or they got additional child care credits, or they got additional credits in the tax system. They're saving it. They're taking their deflationary savings in other areas and spending it. They're taking their lower energy costs and they're spending it back in the economy. You look at Friday's Black Friday, which was really online sales, and you take Monday's Cyber Monday sales, those were 2 record days. I mean, monstrous sales days if you look at the credit card data. So the consumer's doing what the consumer should do. So that part of the economy looks really pretty good. The one concern I have in the US, and I've had this now for a year and a half, is corporates are not spending money in the United States. And I totally get why they're not spending money. If I was a CEO, I probably wouldn't be spending money. If I sat on a corporate board, I wouldn't be doing big CapEx right now. First of all, if you start down a big CapEx project, it's property, plant and equipment, it's buildings, it's things like that. First thing you're gonna buy is steel and aluminum. Why would you buy steel and aluminum at the world price plus huge tariffs? So you look at that, the cost of that is expensive on one side, and then you look at the other side of the equation with the geopolitical uncertainty in the United States to what is it going to be potentially if we get a change of presidency. What is healthcare going to look like? Are you going to be able to have corporate profits? Are we going to have surtaxes on corporate profits? What are they going to do with corporate buybacks? What are they going to do with corporate legislation? It's a really tough environment to say, hey, let's take 10 or $20 billion and invest it in the US economy right now and look at it on a 30-year payback. I think a prudent CEO or a prudent board would say, hey, let's wait a couple years and we could probably make that investment in the future, or worse, we could make that investment in another country and import those products. So unfortunately, I understand why CapEx and corporate spending is down in the United States, which is disappointing to me, because one of the big motivating facts behind the tax legislation was to incentivize companies to spend money in the United States. That said, again, though, we still are at 3% wage growth. We're at sort of 3.5% unemployment. We still have 7.2 million job openings in the United States. So from that side of the equation, it looks pretty good. So I continue to be cautiously optimistic in the United States.
Go on.
So I've got 3 or 4 things on my mind that fit in that bucket. One is a fundamental change in the nature of the relationship between U.S. and China that's going to affect the world economy for the next generation. It turns out that we misjudged Xi, and he turns out to be a real hardliner. Rather than the process that we had of China moving toward a capitalist economy, they are now very firmly adopting the model of state control of very important parts of their economic sectors, and the state use of private actors for espionage and intelligence purposes. That's not going to change anytime soon, and so we're going to have a very, very different way in which the United States and China manage their relationship with each other in the coming years than we have in the past. One very good example of that now is largely an assumption in the technology community that we're going to have two internets on either side of a great Chinese firewall. That's kind of one. The second is that I was a public critic of the tax cut because I doubted seriously that it would increase economic growth, and it hasn't. It didn't, and whatever economic growth it offered was going to be fleeting, which it proved to be the case. And that I thought at that stage of recovery, given the level of federal taxes as a percentage of GDP, which was at well below historic averages, that it was time to get our fiscal house in order. I'm very, very concerned about the nature of these massive deficits the United States is running during a period of peacetime and recovery. And if you want to maintain the United States' centrality in the capital markets, one of the things you need to do is be a capital provider, not the world's largest borrower whose sovereign credit risk is deteriorating systematically. That's the second thing I worry about. Third thing I worry about is even though the economy is strong and not strong, but the economy is growing, call it 2% trend, and unemployment is at historically low levels, you still have a massive amount of economic insecurity in the American household. The volatility in people's wages and the volatility in their spending, their low level of their savings without any cushion means that there's even in a very strong economy, we still have this very profound sense of economic insecurity in very important parts of our country, and that's reflected in a whole host of political and social and economic trends, and we need to address that, and the strong economy hasn't addressed it. Third thing. Fourth thing is I'm very optimistic. Because I am on the board of a company I know is America's largest capital spender right now, AT&T, and is one of the largest capital spenders in American history. And we're building out the 5G infrastructure. By the way, my personal view is the reason why that companies that have good commercial propositions and can grow in the technology economy are actually investing quite aggressively. Take Amazon, for instance, as examples. And we're going to build out a 5G network that's going to offer wireless speeds at 50 to 100 times what you get today. You'll have a wireless experience as good, if not better, than your wired experience, just as 4G enabled the creation of a whole host of companies on top of that platform that didn't exist before, everything from Grubhub to Airbnb to Uber. There will be a whole host of new kind of economic constructs that will be able to be created on top of the 5G infrastructure that are going to create a whole new layer of economic growth. It's one thing that the United States will be competitive in, though China's ahead of us for a whole bunch of reasons, will be competitive in, unlike the digital currency stuff where that might migrate outside the United States for reasons we've talked about. And so that's a real reason to be optimistic. It's going to be a lot of fun to both invest in those companies and then watch them deploy products and services.
Well, I'm gonna close this out. I'll give you a chance to say any final things, but let me close it out with a few words here. First of all, it's wonderful to work in this job in a country where you can have this kind of discussion about how we look forward, the risks we face, the role of government, have it in front of people out in the open, talk about risks, talk about different perspectives. It is a great privilege. I know you've experienced it, but it is a great privilege to be able to live in a country where we can talk candidly, learn from each other, look forward, and try and do our job better. And that's what today is all about. And I just want to say I appreciate your sharing your views and sharing them in a way that we can all digest them and be better for it.
Can I say one thing before we go, which is, I don't want people to misinterpret what Gary and I both said, which is one of the reasons why we have the greatest capital markets in the world is because they're the ones that are the most effectively regulated and in which all the rights and expectations that investors have can be enforced.
Yep.
can be predicted and enforced in the United States. So please don't interpret anything that we said today as being critical to this organization, because I see it as a centerpiece of kind of the financial markets. I have a huge amount of respect and admiration for everybody who does, and does, and I just want to make sure everybody understands for saying that.
Agree completely. Look, we would not be in the position we're in without the regulatory system we have in the United States, and I applaud it. Sometimes I'm angry at it, but I applaud it.
So thank you for what you're doing. We really appreciate it.
Now, thank you. Please join me in thanking these wonderful guests.
All right.
Thanks, brother.
Very good. Very good. I'm gonna hit this.
Good morning. Welcome back. I hope you enjoyed the previous session and the kind of give and take that took place. I hope we will be able to replicate that. It's a tough role to follow, but nonetheless we will try. I'm delighted to have a panel of 4 distinguished individuals here. I will begin with Craig Phillips, who was a counselor to the Secretary of the U.S. Department of Treasury, focusing on financial institution and capital markets policy, debt management, fiscal policy, fiscal operations, government asset and liability management, and general economic policy. Did I leave anything out? Before joining the Treasury Department, Mr. Phillips was a managing director at BlackRock, where he led the Financial Markets Advisory Group, and prior to that, he was managing director at Morgan Stanley. Next, I have, it's not in this in order, but Gillian Tett. She is chair of the editorial board and editor-at-large U.S. of the Financial Times. She writes weekly columns covering a range of economic, financial, political, and social issues. In 2014, she was named Columnist of the Year in the British Press Awards and was the first recipient of the Royal Anthropological Institute Marsh Award. One might wonder why the Anthropological Institute might award her, but as I understand, she has a PhD in anthropology, correct? So Ms. Tett's past roles at Financial Times have included U.S. Managing Editor, Assistant Editor, Capital Markets Editor, Deputy Editor of the Lex column, Tokyo Bureau Chief, and a reporter in Russia and Brussels. Any Russia connection, in the? Oh, yes. I'm delighted to have Jennifer Marietta Westbrook. She consults on economic and financial issues arising in litigation and regulatory investigations in financial markets. Dr. Marietta Westbrook served as the Deputy Chief Economist and Deputy Director of the SEC's Division of Economic and Risk Analysis from 2013 to 16. So welcome back to the SEC. At the SEC, Dr. Marietta Westbrook served as the Vice Chair and Chair of the International Organization of Securities Commission's Committee on Emerging Risks. Prior to joining the SEC, Dr. Marietta Westbrook was an assistant professor at Michigan State University. Finally, I have Marko Kolanovic. He is the global head of macro quantitative and derivatives research at JP Morgan, where he is responsible for overseeing a team focused on developing macro derivatives and quantitative equity strategies. Prior to joining JP Morgan, Dr. Kolanovic was global head of derivatives and quantitative equity strategies at Baird and a derivatives research analyst at Merrill Lynch. The format would be that I would be posing one question to each of the panelists, and they will have the primary responsibility of responding to that question, but others are most welcome to jump in, react, and we will have a free-flowing discussion, and then we will have about 10 to 15 minutes for audience participation as well. Okay. With that, let me begin with Craig Phillips. Craig, in the panel earlier today also we heard a lot of concern expressed about the level of corporate debt, including leveraged lending, CLOs, and the growth in corporate bond market. Coupled with that are some global events like economic slowdown in China, India, and some other parts of the world, which only has contributed to that concern. Should we be worried? What are your thoughts on that?
Well, sure. What I'll try to do is put in perspective what may or may not be wrong with the leveraged loan market, but really talk a little bit about the regulator's role in thinking about future risk. We're talking about markets, and obviously one topic is, where are we in the cycle and kind of how should the regulatory system respond or how it should not respond. So I'd say in general, because of lower for longer and the rate scenario, we have this highly extended business cycle around the world, which is unprecedented, and eventually the cycle will turn. We've not eliminated the business cycle. So it is true, corporate debt will be vulnerable, consumer debt, house prices when you have a recession. As a regulator, you don't know when that will be or what will cause or trigger it. I think in the first panel, you heard a lot about the debt bubble of sorts, the tremendous increase in debt, including sovereign debt, and this being amassed at such a low yield. I put that as a much higher risk than leveraged loans writ large. And when you look at the statistics, maybe just frame the facts a little bit. A common fact quoted in the press is the 10 trillion of debt, of non-financial debt, which is approaching 50% of US GDP. I always love the non-financial part because that ignores all the bank debt and all the financial debt. And a lot of that debt now can be bailed in as TLAC, which is an exercise we've never experimented with in a cycle where an institution in failure turns its debt into equity. So when we talk about the non-financial debt, we're ignoring a big chunk of debt that is worth paying attention to as well. And people always say that ratio of 50% has preceded recessions in the past. It's like the shape of the curve. I don't think that necessarily is causal, but it is a cause for concern. So I think what regulators should do is watch these type of indications. Now, a couple other facts are, which would be notable, is there's a higher concentration of BBB debt in that mix, much higher than it historically has. And I personally believe this is arising from the nature of how corporations finance themselves and a predilection to stock buybacks to really optimize their capital structure and an acceptance of the market for that. And partially, it's been compressed closer to junk because sovereign ratings have fallen over time, and there are very few to zero AAA companies anymore and very few AA companies because sovereigns have been compressed. So we live in a very narrow alley in the investment grade space relative to what we used to when people refer to previous statistics. But what that really exposes us to is a higher number of fallen angels. When things go from BBB to BB and are junk, many investors have to sell these securities, which would precipitate a contagion or a market impact. There might be other factors, but that's one of the biggest things. SP and his group put out a report today on this topic, which I've not had the benefit of reading, but I think in general there's very little in the performance now that's a concern. We do have some defaults. Some of the defaults are unexpected. You don't think of utilities of being high-risk area, but PG&E finds itself in default due to an operating risk in its operations in California. So you always have a default pattern, but there's nothing elevated in defaults. But what has happened is the loans are all held in elsewhere than banks' balance sheet. Banks originate to sell. They're held in CLOs, which are collateralized loan obligations, a form of securitized product, and also in loan mutual funds, a product the SEC would look over. And the reason is that we created very high bank capital and liquidity standards, which gave banks an incentive not to hold corporate debt. So really selling off corporate debt optimizes their capital treatment and was really caused by better capital management at the banks. So as Gary and Glenn said earlier, we've ended up with really what we wanted, sort of less risk in the regulated insured banking system transferred to end buyers. So I think when people talk about that as a problem, I take really big exception with it because it's actually the successful outcome of a regulatory strategy. You may want to change that strategy, but that actually is really what the capital rules have dictated. And also the speed of trading and electronic trading has now moved to the corporate bond sector. So dealers are able to move their positions extremely efficiently, at the speed of light, as Glenn mentioned, and with trace data that's collected now and published by the SEC, with their blessing in corporate world, there's a lot more transparency and speed in trading. So really what we have is something that feels a lot like the financial crisis in a way. There's loans and securitization. People are originating to sell. Is that a problem? I think a big difference is the structures of COs are relatively sound. They don't suffer from excessive leverage. The sponsors are largely extremely professional in terms of the top asset managers in the world, and I don't see a lot not to like in terms of their qualification. And the holders, I think, are qualified to hold the risk, i.e. there's less speculation, and it's just a legitimate asset class that, becomes attractive in a search for yield, but does not seem to be inherently ill-structured or mispriced. So I'll finish with sort of what should the regulator be doing or not doing, because the market regulators and potential regulators don't tell people how much risk they should take. They advocate for market transparency, normal liquidity and predictable liquidity, and also capital standards for banks that are sustainable. And I think the outcome of this is a directly result of that. So first of all, the holdings being outside the federal umbrella doesn't mean regulators shouldn't care about that. So there is a focus with the banking regulators to think about the standards that are being used. But the securitized products are not directly regulated by the SEC. The sponsors are. People decide how much risk they want to take. And when you get in the end of a business cycle, I think market discipline is highly important, almost more important than regulatory discipline, because the market makers are the ones that really put the brakes on activities. The size of the leveraged loan market is not a concern, and I think that's what's curious about it being used as a proxy for financial crisis. It's about 1.2 trillion. That's a pretty small number relative to the total debt market. It's quite a small number relative to total corporate debt, because corporate debt is a matter of investment grade, high yield term bond debt, and leverage loans. And obviously you have a lot of small and medium enterprises that so borrow that are also corporate debt. So 1.2 trillion is a very small percentage of that. So FSOC, gathers regulators to talk about issues. When I was at Treasury, it was discussed twice. It's been discussed since, is my knowledge. And so everyone's sort of just sharing information is key. Why do you share information? Well, you then realize there might be gaps. One consideration was, kind of the bank practices in lending. One consideration is, do loan products settle regularly enough so if you have a market meltdown like we had last December, can mutual funds sell loan and settle on a timely basis? So there's always some room for improvement that regulators can influence. And then half the values is regulators interacting with market participants to really truly understand what the risks are. And I think that SEC under Jay Clayton's leadership does a great job of that. The other fallacy is the Trump administration didn't really loosen any standards that's impacted this. You also see the politics in these things. A lot of attention was put on this issue from the Hill. This is the next financial crisis, and that somehow the administration was causing it. Really, as I mentioned, there was some loosening of guidance by the OCC and some clarification, what's a regulation, what's guidance, which I think was very constructive. But largely, the trend of selling off these exposures and how they were financed had unfolded over many, many years, and no current policy was really accelerating that. So the politicization of risk is frequently a distraction from sort of the true work of regulators, which is monitoring risk. I think the real message is regulators have to be agile and monitor risk. As Glenn Hutchins said, the next crisis might be cyber or some other attack. You can't be backward looking. Investors are paid to take risk, and you really want to have liquid, transparent markets and disclosures, and that's why I think CLOs and loan mutual funds have a huge advantage over the structures we had in the financial crisis. Dialogue with the market participants is important, but really market leadership is really what I think is important at these market turns, if you have a turn. The WeWork example was one where it was the blind leading the blind, that somehow if the IPO went, somehow someone should do a leveraged loan. And of course the equity players put the brakes on, there was no leveraged loan. But that's just an example of how close you can come to a situation that would have been completely ill-financed in the marketplace. So I'm a believer in smart money in markets and integrity in markets, but you really have to look at covenants, leverage, and the very important role of the rating agencies in sort of setting standards that aren't too permissive. And I think that's an area, if I were to offer advice, is the rating agencies are the ones that really can put the brakes on at the end of the day. So I think last crisis was driven by residential mortgage crisis. We've had crises driven by bubbles in commercial real estate prices and stock prices. We may have a bubble now, which is the aggregate size of debt at very, very low rates. But I think the U.S. consumer is in good shape, the economy is in good shape, and I see little in the leveraged loan market performance right now to sort of either have a sign of worry or feeling it's going to trigger another financial crisis or even a setback in financial markets.
Excellent. Yeah. If I may, just, you touched upon from the standpoint of those who have borrowed money, those who have lent money, okay, and who are holding that debt. Is there any concern as to who has borrowed? And that information is less readily available. Who are the ones who borrowed money, which ultimately became CLOs or?
Well, I think, a lot of your question is how transparent is the data on this? And I did find when the regulators talked about it, because banks were selling off the exposures, the prudential regulators rightly weren't that concerned about the exposures because the bank didn't really continue to own them. Now, it's easy to sound insensitive that you don't care about that, but it's just a fact. If the banks don't own the exposure, the regulators aren't tracking it. So I do think the data transparency, there certainly are private data service that really tracks CLOs and managers, but I really found from the regulatory side, data was really hard to pull together on the concentrations. At the end of the day, it's not unlike the stock market. When you have a problem, the last crisis was a globally synchronized credit and liquidity crisis. That's very unusual. Normally what you have is a rotating crisis that's based on industries, asset prices in those industries, flows, things, for instance, we have this burgeoning trade war, certain companies will be affected much more negatively than others in such a war. Some will perhaps benefit from such a war. So I think the underlying data is a little troubling because it's very fragmented. Yep. And, but between private sector and public sector, that is an important thing because really the concentration by industry, borrower size, and also the leveraged loan is sometimes a short-term market that's meant to sort of refinance into the permanent bond market, and looking at those short-term financing events frequently also worth doing that. So I did find that tricky to sort of get the right data on the borrower.
I've been struggling with that as well, so
yeah.
Good to know that I'm not the only one.
Yeah.
May I turn to Jillian, you? Oh, I'm sorry. Jennifer, you want to say something? Yeah, please.
I just had one follow-up question for you on the data. So as you said, you may not have all of the data, or the regulators may not have all of the data they need to monitor some of these issues. And do you see that there is a path forward for them to be able to acquire that data? Sometimes in my time at the SEC, it was difficult. The data existed. It was out there in the industry. But for various reasons, it didn't make sense for them necessarily to want to provide that data to the SEC. So how do you see a path forward to get the data you need to effectively monitor this market?
Well, look, I think one of the failures prior to the last financial crisis as it related to securitized product was there just wasn't enough transparency what were in all those pools, and there was, the rating agencies weren't vigilant enough, et cetera. So without touting any private services, I think largely there are private services now with the increase in data and speed and cost. The data is available, but the key is how do you get it into the regulators' hands so they can really make the correct decisions. The SEC oversees asset managers writ large, but doesn't particularly opine on the individual securitizations that they sponsor. And some of these are sponsored by entities that would be probably outside the SEC umbrella in terms of kind of what was negatively referred to as a shadow banking system, but things like business development companies and others that are not really directly in the purview of the SEC. So I think your question, again, as SP said, is a challenge. How do you, now that the SEC has implemented data reporting on securitizations in general in Reg AB, and that's expanded, but also the private market has demanded it. So I think most successful solutions are a combination of public and private. I think the biggest struggle is for the regulators to have as good a data as the private sector. And so I think that cohesion is important, and having the budget to subscribe to data services and other thing is probably part of the answer, because it's all out there, but it's actually a little more in the private sector than actually easily created by the public sector, or through, say, seven of the filings that we require. Maybe there should be better filings on this, but the data I think is now relatively transparent, which is one reason I feel pretty good about the sector.
Let me turn to Jillian Ted. And I'm going to ask about, ask you to reflect on Great Recession or the financial crisis of 2008, 2009. That was a global catastrophe. And at that time, of course, developments in Europe and Asia affected the US and markets, US markets and vice versa. Now, what's happening currently in Europe, Asia, and Middle East and elsewhere? How is that likely to affect the US or the global markets? And at the same time, I also want to note that we see little market reaction related to Brexit. Is that just due to fatigue, with that topic, or is that still an important macroeconomic issue?
Well, those are all very big questions. I would echo what Gary said earlier about the level of geopolitical risk that's swirling around in the minds of many investors and CEOs right now, because the world has become deeply uncertain. And to tie together the points you made, I think that the financial crisis of 2008 really showed us all three things. One was that we can't trust the geeks. Before 2008, there was a lot of faith, or a lot of blind faith, in the idea that financial innovation was a fantastically good thing that would deliver great benefits for society. And when I go back and look at what people were telling me in the financial industry pre-2007 about how fantastic CDOs and CDS were, it's actually quite hard to believe that anyone said that with a straight face, because there really was a very strong belief back then that innovation would create perfect liquefaction of markets, perfect allocation of risk. Innovation would always be a good thing. And 2008 was a very brutal wake-up call that that's not always true, and you can't just trust the geeks to keep doing things that no one else understands, which have potential to hurt us all or affect us all. The second thing I think happened in 2008 was that it really brought home for the first time the power of globalization and the degree to which the financial markets had become intertwined in ways that people didn't fully understand, and that we were living in an era of contagion, but contagion that was very poorly understood most of the time. But the third thing, which I think 2008 taught us, and this really comes into the current geopolitical risk, is that sometimes very, very weird things can happen. And I say that with feeling because I started my career as an anthropologist in the former Soviet Union. And I did my research in the Soviet Union when the Soviet Union was still the Soviet Union. And then watched a society that I and others thought was completely stable collapse dramatically. And when I then came back to America and Europe, I used to feel like everyone here was just living on a completely different planet, where the idea of systems collapsing or paradigms suddenly being turned upside down dramatically just wasn't in the conversation. But 2008 didn't just create a crisis, it showed everybody very fundamentally that systems can suddenly collapse, institutions can collapse, paradigms about what's safe in finance or what central banks do can suddenly be overturned. And I think that's having knock-on implications in all kinds of ways, including the political sphere today. You know, nothing is quite entirely unimaginable anymore. So to come back to your point about how are events in the rest of the world impacting America, in the obvious way, you know, if we are heading for a slowdown in China, if we have a trade war, if Europe is a mess, and it feels like Europe is almost always a mess, if Britain is even more of a mess, and British politics these days looks like Italian politics, but without the cooking, you know, obviously that's going to potentially hurt the US in economic terms. But I'd say the much more important issue is one that Gary spoke about, which is this gnawing anxiety inside many investors and C-suites that we just don't quite understand how the system is interconnected today. We just don't totally understand what the geeks got up to. And we just don't have the sunny belief that we used to have pre-2008 that the world is predictable. And I think that is actually having a dampening effect on investment. Of course, it's leading many investors to keep chasing for yield and risk right now because they think that in this world of great uncertainty, rates will be low almost indefinitely. But it's a very, very strange, almost Alice in Wonderland landscape today.
Yeah, I would just add one thing. You mentioned sort of instability in Europe, in potential tensions with China, reflecting back on the U.S. market, and it's kind of like uncertainty coming to U.S. I would just add also the angle that U.S. is actually exporting some of the uncertainty right now. I mean, if you have the whole concept of a trade war, really that's a sort of the concept that started here with the Trump administration. But even some of these political movements, I mean, you have a sort of people like Steve Bannon kind of going around Europe and sort of kind of propping up the fringe movements, and even the U.S. ambassador in Germany, kind of Richard Grenell, kind of saying like, hey, far right needs to be like respected more, needs to be more prominent in media and stuff like that. So I agree totally. The world uncertainty is overall increasing, and it's a sort of a two-way street, sort of. And again, I think U.S. current administration plays a big role in that, sort of creating and exporting uncertainty.
I mean, I couldn't agree more. And I think the point I'm trying to make is that, generals are trained to fight the last war. Regulators are trained to obsessively create rules to stop what happened last time happening again. And journalists are trained to try and scoop the last crisis, always. So, we in the media have been obsessively looking out for more signs of crazy mortgage behavior, securitization, derivatives, CLOs. I think a lot of the obsession with CLOs right now reflects echoes of the past. But as Glenn said, I am very struck by the level of climate risk right now and the potential that can have an impact on portfolios. I think that in many ways the phrase stranded assets is like shadow banking was in terms of clarifying the issue for the financial industry in a way that we journalists can put the problem on the front pages of newspapers and quickly describe it. I'm also very struck by cyber risk. I think that's a very, very real issue. But I think political risk is one of the biggest issues, because it's not just about trade wars, it's about, are we going to see in the next 5 to 10 years a big lurch towards the left? Are we going to see essentially financial repression being the answer to this huge debt burden? Are we going to see nationalization? All kinds of ideas which are seen as being completely beyond the pale, not just 10 years ago, but 5 years ago, are suddenly becoming mainstream, modern monetary theory. When you have hedge fund managers like Ray Dalio from Bridgewater talking seriously about modern monetary theory and how that would affect investing, that's another sign that, none of the paradigms we thought were so secure are secure anymore.
One comment or question I have is, it seems like the voters obviously voted for Brexit, but on both sides there was the idea of a win-lose situation. Somehow it'd be either good or bad for the UK, and the opposite would be true of Europe. And now I think we're looking at a situation that might be a lose-lose, so it's bad for both. But in the capital markets, as a topic of today's conference, it seems that one of the real risks is sort of market fragmentation. And then also that if banks kind of leave London, rather than moving their activities, they just might further de-emphasize their capital markets activities and just revert to home country credit support and behaviors. How do you look at that as the outcome of this, of fragmentation and just less capital market cohesion in Europe?
Well, you can see the fragmentation. I mean, if you look at all the charts on, globalization, DHL does a lovely chart looking at globalization on 4 measures: information, people movement, financial globalization, and traded goods. And it shows very clearly that information keeps going like that, people goes like that. Financial globalization fell sharply after 2008 and hasn't really recovered. So horrible words like subsidiarization, which I still can't say properly without a lisp, have become flavor of the day. And I think that's absolutely a risk that people are, in many ways, underestimating.
If I can add just one thing also on the risk side, you talked and I mentioned sort of the political risk coming from largely from the right side of the spectrum. So that would be sort of all these populist movements, nativist movements, nationalist movements, protectionist movements, But on the left side also there are a lot of risk, and you mentioned also environmental. It's becoming almost like a little cult-like movement that can actually produce a lot of financial risk. So if you look at these CLOs and CCC branches or equity branches, they're basically stuck with energy credit, which is the only outlier, right? So these are companies which are cheap, price per book value. They're necessary in our everyday life. I mean, we all use fossil fuels, but assets are basically suppressed artificially, based on some political agenda which comes from left, So sort of you have right is using an agenda of immigration, protectionism, left is using this agenda of sort of climate risk that we're all going to kind of die from, drawing in a sea in the next decade or something like that, which can create financial risk, but also can create disruptions. If you starve certain parts of industry, which are a critical part of industry of capital, eventually it's going to backfire. Production is going to shut down. Energy prices may spike dramatically and cause massive sort of recession. Because in that type of environment, central banks will need to prevent inflation. So it's also playing with the fire. So both left and right political agenda are meddling in the markets, meddling and creating a big risk actually down the road. So again, on the right side, it's generally sort of immigration, trade war, tariffs. On the left side is basically kind of let's fight some sort of ideological issues in financial markets and kind of create instability both in the financial segments, but also eventually spilling out in what you see, for instance, gas prices rising in California, and then you had sort of some of the politicians in U.S. kind of advocating for stopping the fracking, which would basically immediately cause a Great Depression, right? So if you stop the fracking in U.S., oil would go probably to $200 very soon, and you will have a sort of you will have depression basically in a few months. So this political risk is very obvious kind of from the right side, but also is actually coming from the left side as well. So that's, I think, what's different from 2008, that now sort of politics is one of the big drivers of risk, less so than leverage or innovation.
I'll say one more thing quickly about this issue of climate, which is that when I talked about the word shadow banking being like stranded assets, what I meant was that before 2008, I firmly believe that one of the reasons why so few people understood the risk building up in the world of securitization and CDOs and CDS was because there was no word in English which you could easily use to describe all the stuff that sat outside banks. I remember Paul Tucker, the Deputy Governor of the Bank of England, struggling desperately at a conference like this to try and make the problem sound exciting. And it was just drowning in acronyms, CPDOs, CDOs, all these kind of acronyms. And I went back to my editors, because I was obsessed with this stuff, and said, we've got to get this on the front page. And you could just feel the eye roll, and there was no data, and it just sounded so geeky and boring and dull. And when someone stood up in the summer of 2007 and invented, it was actually a guy from PIMCO, Paul McCulley, said the word shadow banking, at a stroke, it changed the conversation. And everyone began to realize what was going on inside the system and began to have a name for the risk. And in the same way, I think the word stranded asset is having the same impact on the environmental and financial debate, because people have vaguely known that, if climate change is real, and most importantly, if governments and investors change their attitudes towards it, then the value or the price of some things might change in the future. But there's been no way to really talk about it or communicate the risks attached to it, and there's been a real lack of data trying to quantify it. But now people are talking about stranded assets, and suddenly it begins to crystallize in the mind. And it doesn't matter whether or not you believe that climate change is real or not. And it doesn't matter what Trump does in relation to the Paris Accord. If enough investors and governments start to think it is real, then that changes the price of assets. And what Brussels is doing right now in terms of the taxonomy of green is in a way going to have the same impact on the debate as GDPR in the tech sector. Because just as tech companies cannot ignore GDPR if they have global operations, American companies in the future and investors won't be able to ignore what's happening with Brussels and the taxonomies and rules emerging there. And that could change the value of assets in ways that people just haven't priced into the markets or thought enough about, in my view. It's a long-winded way of saying I agree.
While we are on this topic, can I just make one point? To what extent easy credit was the issue? And 2008, it started with a lot of easy credit. And are we seeing same thing or similar concern now as that? Your point about the pricing of risk, or what some of the, let me use the word how they passed it, the geeks passed it as, oh, this is safe, and others believed in that. That is certainly part of it. But part of it was part of it, easy credit. And to what extent we are saying the same thing repeated, and that's why I asked about the CLOs, who are the borrowers? Because if they are borrowing for no reason, they are not credit worthy, but they are borrowing, then of course that story is not going to end well. And no easy credit story has ended well. So I'm sorry for being long-winded.
I think not to jump into defense securitization, but I think in a way the regulatory framework that's been altered since the crisis has eliminated a lot of risk from the system. So we talked earlier about CCPs, but really, standardized clearing of derivatives, all deliver exposures are now transparent and collateralized. That did not exist before. Bank capital and liquidity standards are extremely high and have to be continuously replenished. That's a difference. And there's almost no counterparty risk. The reason the Fed balance sheet has to keep exploding is that banks won't lend to each other. And so really the central banks, for good or for bad, are now the sort of the intermediaries of many of the short-term exposures that really start the contagion. So I really think securitization is a symptom rather than a cause. The real causes are their weak credit standards in lending. And if all the subprime loans had been held on the bank balance sheet, but they'd been made, that would have been as bad or maybe worse than being a securitized product. So how risk is transferred, the root causes are credit terms too liberal and loose. If we talk about mortgages, the average FICO of a loan produced last year and purchased by Fannie and Freddie is 740, which is almost 100 above where it was at the crisis. So if you go to mortgages, it's totally different. In the corporate side, I do think corporate finance has changed. There's a lot of stock buybacks. Companies are more leveraged. And it's just a fact. We're going to have more fallen angels if there's a setback. And that market might close. And if the market closes, how will companies get loans? So I do think we have more vulnerability to the nature of the reliance on CLO and securitization in the leveraged loan market. But again, because it's only 1.2 trillion out of the whole market, there's numerous other ways they can finance themselves, including the bond market. So sure, certain transactions might stop, certain companies might be further downgraded because they suffer from liquidity, but I think the characteristic could only truly change if you change the capital rules for banks and encourage them to hold these loans again.
Can we move on to next question? Jennifer Marietta Westbrook. An aphorism is that new wars are born from the end of old wars. How did our efforts to fight the last financial crisis influence current market conditions? What has improved? What are the new stress points?
Thanks, SP. So in order to discuss where we are now, let me back up a little bit and talk about where we were then. And you just brought up the aspect of easy credit around 2006, starting then. So at the very highest level, there are obviously multiple factors contributing to the financial crisis of more than a decade ago. But at the highest level, we had an overactive housing market in the 2006-2009 period that was supported by loans to subprime customers who were ultimately unable to pay their mortgages. These mortgages were then repackaged, securitized, and sold to banks and other investors throughout the global financial system. So you had mortgages packaged from Indiana or Utah that were then securitized and affecting banks in Iceland and Ireland. So it was quite a global effect. You also had, again, it's sort of high level here, banks exposed to these house poor customers and their mortgages, and in some situations with very significant leverage by the banks. So Dodd-Frank came in after this. I was at the SEC from 2006 to 2016, so I had both a pre and post view of life at the SEC before and after Dodd-Frank. So that particular financial regulation was, of course, hundreds of pages, numerous rules that were required. Just some of the things that the rule required, it formed the oversight agencies of FSOC and the CFPB. Some of the bank requirements, it designated banks with assets greater than 50 billion to be systemically important. And this would subject them to stress tests to evaluate their health on an ongoing basis. There were also, there was the Volcker Rule, which carried certain prohibitions against speculation or proprietary trading within the banks. Of course, some of these things have been revisited by today. There was greater scrutiny required of mortgage lending. This was something that's been brought up. restrictions on the Federal Reserve's ability to act as a lender of last resort. There were also some things that seemed maybe not directly tied to the financial crisis, like capping debit card fees, so there were a few things like that sprinkled in. And then I haven't even gone through the numerous rules that the SEC worked on that really affected numerous registrants and numerous entities that the SEC oversees. That would be the CDS, the swap markets, asset managers, broker-dealers, corporate issuers, credit rating agencies, and more. It was a very intense time here. So setting the stage for where we were, where are we now, and then we can talk about some potential stress points. Some of these points have already been made either in the morning session or today, but the housing market has recovered in many major cities, places like Silicon Valley, or at one time New York City. I think that's falling off a little bit now, but less so have they recovered in places like Las Vegas or Phoenix. The home loan market is comparatively to 10 years ago more stringent requirements than then. A smaller percentage of borrowers are exposed to adjustable rate mortgages than they were a decade ago. And interest rates are lower now than in 2008. So if interest rates are moved up, there may be a lower probability that they could negatively impact the market. Banks' capital and leverage ratios are higher than they were a decade ago. So, these are some very significant movements over time. Some aspects of Dodd-Frank are being revisited, as I mentioned. So a bit more than a year ago, the Treasury Department was focused on this issue and declared that the Dodd-Frank regulations had, quote, failed to address many drivers of the financial crisis while adding new regulatory burdens. And they suggested some areas to be revisited. And I think, in their words, the goal was to try to improve the efficiency of the regulation and maybe reduce some of the complexity that wasn't necessary. I'm not going to go through all of the recommendations, but just a flavor of these included raising that threshold of $50 billion that designated banks as systemically important from $50 billion to $250 billion, revisiting the Volcker Rule, which has been done, reducing the amount of financial reporting in some areas, lowering the frequency of regulatory exams, and easing some of the conditions of the stress tests. We heard on the morning session that banks, not just large banks, but small and mid-tier banks, are concerned about the level of costs for complying with a lot of the regulation. And so I think some of this seems to be aimed at those concerns. So in moving from where we were to where we are now to thinking about possible stress points, as you asked, SP, I think there are conversations about different potential pressure areas. Some of them were mentioned this morning, but I'm going to focus more on those that may be related to how we addressed the crisis 10 years ago. Areas like cybersecurity, I think, are very important. I know Chair Clayton is focused on that, and we heard some other areas this morning. But focusing on areas that may have been related to where we were 10 years ago and how we decided to fight that crisis. So risky lending may be occurring less in residential mortgages, but appears to be increasing in consumer loans for things like automobiles or short-term cash loans. So while this may be an area of concern, the value of the bonds backed by, let's say, subprime auto loans is just a fraction of the value of mortgage-backed securities. So while this may be increasing, its value is small on a proportional basis. I won't go more into corporate debt and the increase in that because I think that's already been mentioned quite a bit. But that corporate debt relative to GDP has increased quite a bit. U.S. household debt has also hit new highs over this more recent period. And returning to the costs of complying with regulations like Dodd-Frank, those could potentially create barriers to entry to other entities wanting to enter the financial industry, which, as I said, mid-tier banks and smaller banks have argued that it's the cost of compliance is making it more difficult for them to compete with larger banks. I do think the number of new bank charters has fallen quite a bit since the financial crisis. And so if there is a concern about too much concentration in the financial sector, then barriers to entry would only enhance or exacerbate that concentration. The mid-tier and smaller banks, in their arguments about why these compliance costs may be too high or too costly for them, say that it translates into their lower ability to make small business loans and residential mortgage loans, so there could be an impact on the economy there. On the other hand, bigger banks are better able to take advantage of scale economies. So you have sort of pros and cons on each side here. And Gary also mentioned this morning that in his view, he sees jobs also moving not just from small or mid-tier banks, but from the large banks, moving out of the US to lower cost countries. I think there are still questions about whether the increased capital requirements for US banks may disadvantage them in comparison to foreign competitors. And of course, part of Dodd-Frank also restricted the Federal Reserve's ability to act as a lender of last resort in a future financial crisis. So we'll have to see how that plays out. In thinking through where we were and where we are now, I think it's not surprising as an economist, I come back to always the need for research and analysis. In the rush to respond to the financial crisis and implement Dodd-Frank, there really was not a lot of time to conduct in-depth analyses on the financial crisis. So really there are two areas to think about where research and analysis can be helpful. At least two areas. The first is in rulemaking, and the SEC has been doing this for many years. An important aspect of regulatory rulemaking is a cost-benefit analysis and a discussion of the market failure that motivates the proposed changes. Sometimes this is referred to as evidence-based rulemaking. The SEC does provide this information in their rulemakings. And I think in general, investors and market participants benefit from this information, not just from seeing it from the SEC, but would benefit from similar discussions in other agencies' rulemakings as well. And then looking forward, going to the monitoring point that we've been discussing, that's also where research and analysis is incredibly important for effective oversight. Within the SEC here, there are groups like DERA, the Economics Division, that's produced a lot of interesting work studying trends in the market, various features of the securities markets. I noticed there's very recently a paper about the returns to leveraged ETFs. When I was here at the SEC, there were papers coming out of DERA looking at unregistered security offerings, looking at trends in private funds. Now that information was available through Form PF. There's also a lot of research going on throughout the SEC, not just within DERA. But these analyses only cover a portion of the financial system, and I think the point of this conference is to say that we really need to be looking at the macro economy. So the need for other regulatory agencies to continue to put out information as well as the SEC, but not just their own studies, also data, so that academics and others can continue to contribute research and analysis to these respective jurisdictions, not just within the SEC's purview, but across the macro economy.
Thank you. Well, let me turn to Marco then. Marco Kalanovich. I'm sorry. Let me turn to Marco Kalanovich. Debt and equity market structures have undergone a sea change in the past decade or two. In particular, the automation of liquidity, a dramatic rise in passive investing, and an increased reliance on data analytics and machine learning are the new normals of the markets. How do they affect your outlook for debt and equity markets?
Thank you. So what you mentioned, market structure has changed a lot, and some of the other panelists talked about 2008 and crisis and regulatory response, and that sort of planted the seeds for many of these trends. So post 2008, there was a big sort of push towards transparency, liquidity, low cost, and that has actually created many changes in the markets, and the type of the products that are being used. So one particular one is, for instance, growth of passive assets, which both Gary and Jay mentioned. So passive, we estimate before the crisis were about 15%. Now we think they're about 65%. Also kind of push towards transparency gave a boost to some of these quant investment styles, which is basically entirely rules-based. There's no discretion, there is no picking of stocks. It's basically all entirely formulaic. So that segment also increased from maybe 5% to about 15, 20%, depends how you account. So bulk of the market actually is now effectively on an autopilot. There is no human intervention. And when the market is on autopilot, generally does either does nothing, so there's no active decisions, what is good and bad. It basically just goes with these macro flows, and macro flows have been driven by central banks, basically central banks injecting liquidity in the market. So it was a bit of a tide that kind of lifted all these passive boats. And also the passive and quant assets are going back of the back test. When you go back of the back test, basically you're going to see what has worked in the past, and you're going to assume that that's going to work in the future. So you kind of create this momentous type behavior. So you have momentous behavior from quants, you have momentous behavior from passive, because passive actually encourages momentum. Company that's big like Apple, Google, Microsoft, they just attract more and more capital. They and then companies which are small, they get less and less capital. They get starved, and then they get even smaller and smaller. So you have this massive bifurcation in the market. Driven by some of the sort of largely monetary policy, but also some of the regulatory policy. Market is on autopilot, so it's a blind. You have these massive divergences. So I'll mention, for instance, divergence between so-called bond proxy stocks or low volatility stocks and value stocks. So this divergence is now about twice as big as divergence that we saw in a tech bubble. So I genuinely call this a bubble. It's a bubble. So when we ask, okay, where's the next crisis? Well, we need to look at where's the bubble. Where's the biggest bubble we ever had in history? It's basically coming from this bifurcation of the markets, driven by largely central banks, to some extent regulation. So how this bubble happened? If you have like a bond yields which are 30 years yielding negative, well, it's right there in your face, right? What kind of system is that where you lock in your money 30 years for guaranteed loss, right? Something is clearly wrong there, right? And that then percolates into every other asset class and every market segment. So bond proxies, stocks, for instance, that are mimicking those bonds, that you can buy them as a substitute because they yield a bit more than these negative yielding bonds, obviously, are tremendously expensive. So they are like, let's say, trading at 30 times the earnings. On the other side, smaller companies and high volatility stocks that are much lower multiple, below 10. In some of the cases, you mentioned ESG, where you have another kind of push lower, you have companies that are trading at 1 or 2 times multiple. So you have a sort of bifurcation of orders of magnitude divergence, so almost like you had these 2 bottles of water. One, I tell you, is a favorable, one is unfavorable, and I tell them one is 100 times more expensive. So you have gas utilities maybe trading at 30 multiple, and then you have like a gas producer who's taking that gas from the ground, trading at maybe 0.3 times the book value. So literally 100x difference. So that's a bubble, again, largely driven by the bond market, by these negative yields, but also some of these other elements. So changes were basically increase in passive, increase in quant, perpetuates this momentous behavior in asset classes, because bonds were actually in a strong up momentum as driven by central banks. So everything that looks like a bond joins that bubble, basically. So that's a big change, and that's, as I said, that's on autopilot. So it can, at some point it's going to stop working, and then backtest will hit some sort of stop loss. So if you're following this momentum, if you're just buying sort of bonds and bond-like assets and some of these very large stocks that are in favor currently, you're going to just inflate their valuation massively. But then when things turn, computer will say, okay, now the momentum is broken, so now I get out of it all at the same time. Be it sort of CTA or momentous type hedge fund investor or any kind of stop loss strategy, quant strategy, and all of them have stop loss. So then you'll basically hit that wall, and then you'll suddenly have a collapse. So that's where the risk, I think, will come. On the other side, what's equally and probably even more worrying is the sort of liquidity provision, changes in the way liquidity is provided. So 10 or 20 years back, we had the sort of human market makers, block traders, floor traders, prop desks, discretionary investors with discretionary active capital, right? Who were basically providing liquidity and stepping in some of these distress situations. Now that has gone. So technological changes have largely eliminated humans from market making. And regulatory, some of the regulatory changes have also kicked out also the big banks from this type of market making. So big banks are probably also just having these boxes the same that hedge funds have when they market make, right? So now basically all liquidity is provided by these computers, by boxes, and the problem is, again, computers do stuff based on a backtest, and basically they will avoid situations that actually increase their VAR, their value at risk, and that will also lend itself to momentous type trading. Also, because the liquidity provision system is now dispersed across dozens and maybe hundreds of hedge funds, each of these are very thinly capitalized, and each of them use the same model. These are basically models that you provide the market depth based on level of VIX. So your VAR is based on VIX. So you're also sort of what's called vol targeting the risk you're taking, and when VIX goes up, basically market depth collapses. They stop making markets. They do that because it ruins their Sharpe ratio, and they really go just for the Sharpe ratio because they're hedge funds. So that they it's called voluntarily market making status, where they don't have to. They don't have much sort of benefit, but they don't have actually any obligation to be there when the things get tough. So on one side you have assets which are trading in momentum type fashion, and then liquidity which is also trading in momentum type fashion, meaning that when there is a pressure to sell, they just pull back. So that creates these clashes, and so far we have only seen these clashes several dozens of occasions in different asset classes, and we call them flash crashes, and some of them more prominent, like February last year or December last year, and then in other asset classes different dates. But we haven't tested this in a proper recessionary environment, and my strong feeling is that it's not going to hold in a recessionary environment. It's just going to break completely, and you will effectively break this market. So sort of the seeds that were planted in 2008, kind of let's go more passive, more liquid, more transparent, less risk taking, more higher cost of capital, more onerous actually to store risk at the banks, is going to cause actually next crisis, and that's basically is paired with this bubble that came from central banks. So basically, you have on one side passive and quant investing, and on the other side you have like electronic market making that are basically put in place this fragility feedback loop, basically, that when you have a shock to the system, you have selling, but there's no liquidity, and then you have like a sort of tail events. And again, we saw very small ones. We didn't see the big one, which probably we see in the next crisis. I would also just add one last point is basically what have some investors have been doing about this. So increasingly they move to private equity. And I think that's also something that regulators should probably keep an eye, because the way I see private equities now, the way the CDOs and CDO squares were back in 2008. So why were CDOs, and I worked at Bear Stearns, kind of a little bit at the epicenter of that, why were CDOs attractive? Because regulators, the rating agency put like a AAA, so it's approved. It's not being traded. Nobody's really trading it daily, so there's no volatility, and clearly you can lever it up because there's no volatility, right? And so now what you have, same thing with private equity, right? Private equity it's not mark to market properly, so there's no volatility. So it's perfect asset, no volatility. Returns are very steady, I don't know in public markets sort of how credible the returns are, and you can then lever. You can lever them, and you can avoid this kind of going into these public assets and public markets, and you can avoid these flash crashes, and you can avoid the scrutiny just kind of carve that space out, and then you increase it, So I talk to a lot of pension funds, and surprisingly I get an answer. Okay, we are increasing private equity because it's less volatile and it's always delivers positive returns. I heard that answer 3 or 4 times. Always delivers positive returns. It's not volatile, right? So it's a regulatory arbitrage, So again, it is driven by the bond side, sort of the whole central bank, because basically this aversion to volatility. We need to be in something that looks like a bond. So very low volatility and stable yields, So private equity is a kind of also a little bit, the private equity, what I call bubble, is also a bit driven by that. So those are the risks, and they are driven by some of these changes, And yeah. I mean, machine learning, big data, it's obviously important development over the last few years. It's still relatively small how much of that is controlling markets. Still, most of the quant strategies are fairly traditional along the lines of trend following, volatility targeting, or some of the factor risk premium type strategies, But certainly something that we also follow. So I'll stop there. I don't know,
No, I think that's really nice. I think when we started this conversation, I think we very quickly gravitated to sort of the real underlying factors like political risk or desire to shift one way or other toward ESG or maybe not ESG, right? Those kinds of what I call either structural or operational or fundamental risk. And we also talked a little, fair bit about market structure. And I think, Marco, you just now mentioned in the first half of your answer, at least, how we are structured, liquidity provision. Those are also important sources of risk. And then, so we have covered the full gamut. So unless someone has something brief to offer, I thought I would ask the audience to ask some questions for the next 5 minutes or so. In that case, any questions from the audience?
I think there's a horrified silence.
We have static locations as opposed to, so.
Sorry, just a couple questions. The first one has to do with something the chairman spoke about this morning.
I think you have to turn it on. Andrew can help.
Go ahead, we can hear you.
We can hear.
We can repeat the question too, so everyone can hear it.
This one. Okay. I think here. Yeah, just two quick questions. The first one, we know that the U.S. is going to be, for the first time, an oil exporter starting in 2020. United States is going to start exporting oil to foreign country, and that has never happened before. So I was wondering, what do you think, in which way do you think you expect the dynamic of capital market to be affected by that new entrance of the United States as an exporter of the oil market? So that was my first question. And the second question has to do with the adoption of crypto assets. I think some of the people who spoke this morning mentioned that. And in terms of equity, the market equity, what is the regulatory framework adapting to cryptocurrency adoption, along with the blockchain and stablecoin, all that involved? Is the adaptation being done at the regulatory level? So that would be my two questions.
So maybe I'll take the oil question. So U.S. is basically for only 1 month exporter of oil, and this 1 month is sort of at the back of some pretty big disruptions we had in the Middle East back in September, as well as quite a bit of a slowdown of consumption in oil at the back of the economic weakness globally, also, what I would say, or my view is that it's a peak shale production. So basically, the shale has like last 3 or 4 years pretty dramatic increase, and now that's rolling over. If you look at the sort of some sector is basically distressed. So that's your CLO, CCC, equity tranches, and the yields which are 10, 15, 20% on the bonds. So basically, you have a peak production in the U.S. which is rolling over already now. You have a sort of declining demand both in U.S. and globally, the back of largely trade war, and you had some pretty meaningful disruptions in oil production globally. So I'm not convinced that U.S. will continue to be net exporter. Also keep in mind, like the U.S. is exporting sort of light grades and importing sour grades and stuff. So there's a big mismatch as well. So I don't see U.S. turning into for the next decade to be a massive exporter, because I think shale will normalize. I think demand will pick up actually. But right now it's an interesting situation that's basically the sector which is currently in distress globally. So out of all equity sectors, only energy is actually in distress. And it's down for a year, and credit spreads are dramatically wider. So it's a confluence, I think, of the global slowdown, of a trade war, also import-export situation with China not buying as much oil or need, and globally we consuming less, and this basically peak production of shale that is sort of rolling over now. So I don't see dramatic change going forward. But certainly. It's going to be important to monitor the dynamic of U.S. shale oil production, which was really the big difference over the last several years that put U.S. into this spot, which was really only last month that we had consistently for the full month being net exporter. Also, one will need to look at this in conjunction with these ESG developments, right? Because basically there is a sort of quite a bit of a divesting trend, so that may decide the fate of the particularly shale production in U.S. And without shale production in U.S., it would be sort of pretty much catastrophe, I think, in this country when it comes to the price of oil and impact on the broad economy. So I think it's going to be very interesting to monitor this dynamics, how it plays out, and it's a lot of things are coming into it. So it's a trade war, it's a whole ESG movement, and also the fate of the global cycle. How do we? And they're all a bit also interrelated. So I think it's a fascinating part. I think it's too early to say that U.S. is continue just be exporter.
On the crypto topic, for those who weren't there, the discussion between Mr. Hutchins and Cohen and Chair Clayton was, what's the role of blockchain and how does it relate to digital assets? And I think what it pointed towards was that the U.S. has to create a stable policy environment for the sector. And there's a risk that without that policy environment, innovation will occur in other parts of the world unnecessarily. So I think the SEC has appropriately addressed issues like fraud and manipulation and lack of sound collateral and custody arrangements, and should these be included in mutual funds and other things. But that work has to keep unfolding to sort of complete the picture. So actors that have blockchain use cases that involve a digital asset can operate safely and soundly while protecting investors. I think that was one of the big takeaways. I think the larger environment, though, is just regulatory support for innovation writ large. So be it artificial intelligence or using machine learning and credit models, or even financial institutions going to the cloud. We're in really early days in all of those movements, et cetera. So the digital assets and blockchain are just a subset of a lot of different trends that I think are super important to the future of the financial system and markets. And as Glenn noted, the speed in trading, which kind of took over in the electronic aspect of trading, really can spread across use cases for the digital consumer experience and mortgage lending, the operation of their bank accounts and others. So I think sometimes crypto and blockchain gets blown out of proportion as an outlier, and certainly there were tremendous sort of abuses and malfeasance that the SEC is rightly really focused on, but it's part of a very large ecosystem of innovation and how regulators adapt to innovation. So that was a takeaway. And then the other one, I think the other takeaway was blockchain does play a huge role in payments, increasing speed and reducing cost. And some of the solutions involve the usage of digital assets. It was noted that most of the digital assets, of fiat is also digital. We have some cash, but that's a very small amount of the float. So this isn't as revolutionary as it might sound, but how do we sort of leverage potentially blockchain and payment rails to enhance the speed and cost of payments, which is a tax on transactions, and also may be important for inclusion and access to the financial system in certain countries in particular that are less developed. So I thought it was a very interesting discussion. That was the main takeaway I had from it.
Any other questions?
Following up on that crypto perspective, could crypto actually be used as a means to re-enable rehypothecation in derivatives, or basically the reuse of collateral in a trackable form that would kind of repair this problem Dodd-Frank caused, where they cookie jarred so much collateral that can't help the economy?
Yeah, I think the discussion was blockchain has a potential role in capital markets, and certainly intermediaries like the DTCC have well-publicized test cases on how to use blockchain. I think there's two types of networks. One are between trusted parties, where organizers like clearing, which are regulated, and probably clearing is going to continue to be regulated and organized along large entities, use blockchains to enhance the reporting and efficiency of movement. And I think they talked about, can clearing become quicker and more instantaneous than it currently is at end of day and other factors, and blockchain might play a role in that. I tend to think that we're in the stage where blockchain, the early stage of crypto was it's going to replace the whole financial system. I spent a lot of quality time with Mark Andreessen Horowitz, that said the internet was exactly the same way, and then the revolutionists kind of left it when it became more mainstream. So I think we have a state where blockchain and crypto will become more mainstream and have controls. I think that in capital markets, it'll be more blockchain networks between trusted parties as opposed to decentralized networks. But, I've heard a lot of use cases on settlement of securities, documentation of loans. There's an interesting company that's doing a lot on mortgage documentation. You mentioned collateral and sort of transparency. I think that's really what Gary Cohen was referring to, that this is in the very early days and has a lot of potential. It is just another form of database management, so it's not necessarily discovering a new planet, but it is a way of sort of having a record that's immutable, and as they noted, actually catching criminals could perhaps be easier because of that record. So it's not, so it has a bad reputation due to a lot of poor practices, and I think large institutional players, Fidelity's another one that's done a lot of investment in this, are really leading the way of saying how can we integrate blockchain into the mainstream and improve markets. So I'm actually personally positive on that.
Well, thank you.
Anything else? Any other questions?
I had a question for Marco.
Oh, yeah, sure. Go ahead. Yeah.
I just wanted to follow up, Marco, on your comments about algorithms and how they're calibrated based on the back testing. So what is your view of the role of the regulator in oversight for algorithms, particularly because they're in the news at the moment about whether there may be bias, whether it's credit scoring algorithms or lending algorithms, and do you see a role for the regulator? How effectively could that be accomplished?
So I haven't studied credit lending, credit scores, these type of algorithms. I have only studied sort of liquidity provision and investment strategies in public markets algorithms, and I think it's a challenge, right? Because again, sort of semi seriously saying, like, if you look at these liquidity provision algorithms, from high frequency traders, if you have actually, it's kind of semi-serious comment, but if you had the humans execute these trades in this way, they will all be in prison. Like, but if it's an algorithm, actually, it's, you can say, hey, look, I'm doing this because I'm, hedging here, risk this and that, and I'm pulling my bid because of this, and I'm actually putting my offer at this level because whatnot, but it's clearly a jungle, right? And it's clearly now, I would be worried when you have all the sort of brokers giving zero commissions and selling the data. They still have a business, they're making money, so if they're selling your data, so somebody's making money out of their data, and it's not by marketing to you something, it's actually by taking money from you when you transact, so meaning basically they will see when you place some order and they'll immediately pull the bid lower, so effectively they'll front run your order based on the information that brokers sold them and stuff like that. Also, when all these algorithms are basically trying to sniffing out orders and effectively front run them, right? Or when they see a large order, they'll just immediately introduce some buffer, meaning they'll pull the price, below where it should be if it was a fair market, fair clearing market, all participants, and then market immediately rise back, and then they capture that gain. So the bottom line, all of these algorithms are so we have the electronification of markets. There are benefits. Benefits certainly speed, that you don't need to pick up the phone, you don't need to call anything. It's all there. You have tend to have liquidity 24/7. When the volatility is low, there is also more liquidity, but there is implicit cost in it, and actually market is thinner, and market is a lot more prone to disruptions. And most of investors, they don't necessarily care that there's a plentiful liquidity when they don't trade. They more care that there is liquidity when they actually need to transact. And as I said, it's very hard. If someone gives the regulator, million lines of code, how the hell will they be able to figure out, is this something ethical? And it's an arms race, right? Like, there are firms who are like renting the tower, so you have direct line of sight. So you want to get like a nanosecond quicker than the other guy and stuff like that, which is also basically getting ahead of someone, so. And then again, if the broker dealer was doing that, that wouldn't be permissible.
Yeah. Thank you. I want to thank all the panelists. I really appreciate. Thank you, the audience, and for questions. I'm sorry we cannot take any more because we ran out of time. And we will reconvene at 1:15. Thank you. I hope all of you enjoyed this morning's sessions. I know I did. Not only because I was one of the moderators, but in general, I did. The afternoon's panel is on market concentration and fragmentation, and I expect it to be just as interesting. On that note, I will turn it over to Howard Shalansky to get started. Howard?
All right, good afternoon. Welcome everyone for the afternoon session. This panel is going to explore two dynamics that exist to varying degrees in certain segments of our securities markets: concentration and its opposite, fragmentation. And I'm going to say a bit more about our topic in a moment, but first I want to introduce the excellent panelists who will take us through these market structure issues this afternoon. I'm going to start immediately to my right with Nate Goldstein. Nate is currently the Assistant Chief of the Economic Policy Section at the Antitrust Division at the U.S. Department of Justice. He manages teams of economists providing analysis for investigations and litigation in response to mergers and potential anti-competitive conduct. Before joining DOJ, Nate was staff economist in the Economic Analysis Group, in the Economic Analysis Group at DOJ before going to the Economic Policy section for 15 years, working on a wide variety of sectors, including today's sector, financial markets. Immediately to Nate's right is Tobias Adrian. Tobias is financial counselor and director of the Monetary and Capital Markets Department at the IMF, and before that he had a long career in the research division at the Federal Reserve Bank of New York. Immediately to the right of Tobias is Justin Schack. Justin is a partner at Rosenblatt Securities and runs the firm's Market Structure Group, which educates and advises investors, exchanges, brokers, and regulators about topics related to market structure. And last but not least, to Justin's right is Tara Mueller. Tara is Managing Director of Electronic Trading at Virtue Financial. Turning back to our topic, and just to introduce it very briefly, and starting with concentration. We see concentration in a number of segments of the securities markets. For example, a relatively small number of market-making firms are involved in intermediating or otherwise transacting in a large proportion of overall securities market activity. Just by way of example, there are currently 5 firms that act as designated market makers on the New York Stock Exchange, and 3 of these 5 firms account for 90% of the issuers and 98% of the market capitalization trading on the New York Stock Exchange. There is also concentration in the context of off-exchange liquidity provision. For instance, one firm has publicly described itself as accounting for approximately 20% of US-listed equity volume, 21% of US-listed equity option volume, and more than 37% of all retail US-listed equity volume. More generally, concentration exists in other areas of our securities markets as well. For example, the number of firms providing client clearing services for options has shrunk, and there is also increasing concentration in the retail broker-dealer realm. And finally, perhaps the most acute form of all concentration in our securities markets exists in the clearinghouse realm, where in several contexts there is a single entity serving as the sole clearing venue for a given product class. At the same time, we have fragmentation, which in some ways is, as I said earlier, the opposite of concentration in other areas of our securities markets and financial markets. One example is in the context of trading venues. Currently, there are over 20 national securities exchanges that facilitate trading in equities and options, with more likely to come soon. Over 30 stock alternative trading systems, as well as numerous other off-exchange market centers. There are both benefits and drawbacks associated with concentration and fragmentation. Neither is in itself necessarily good or necessarily bad. For example, the proliferation of trading venues offers some benefits to markets and investors. It potentially fosters increased competition for order flow, and in some ways it enhances market resiliency in the sense that if one venue experiences a disruption, order flow can typically migrate to other venues. On the other hand, there are also potential drawbacks, including increased complexity to the system and the imposition of costs on market participants to connect and transact on or across the various market centers. Our panel is going to explore these dynamics, including the relationship between concentration and fragmentation in the securities markets. To start the conversation, I would like to turn first to Nate. Nate, you've been deeply involved in analyzing the competitive dynamics and implications of proposed financial industry mergers and acquisitions. Broadly speaking, what is the framework that an economist at the antitrust agencies would use when evaluating competitive issues in a market? How does that approach differ from that, perhaps, of a regulatory agency?
Thank you, Howard. It is an honor to join all of you, and I look forward to learning from the varied perspectives among my fellow panelists. I will begin in the time-honored tradition of the government employee by expressing my appreciation for believing that my perspective is worthy of sharing in this public forum, followed immediately by an obligatory legal disclaimer directing you to ignore everything I say. The views I express today are my own, and I do not purport that my views reflect those of the U.S. Department of Justice, and thus nothing in this presentation may be cited in any enforcement proceeding against the U.S. Department of Justice. Now, before we get into the details of the potential antitrust issues raised by concentration and fragmentation in equities markets, let me run with Howard's question by providing a higher level perspective of what staff economists do at the antitrust agencies and how that interfaces with our economist brethren at the regulatory agencies, including here at the SEC. Now, depending on the investigation, the DOJ often finds itself examining a particular transaction or strategic behavior alongside a regulatory agency. the FCC for telecom matters, FERC for energy matters, DOT for airline matters, the Federal Reserve for banking matters, and of course the SEC. In some instances, parties will grant waivers that allow information to be efficiently exchanged between the DOJ and a sister agency. The most obvious distinction among these entities is the scope of their respective statutory mandates. Whereas the regulatory agencies often have a broad mandate like, say, protecting the public interest, of which competition concerns may be one part, the Antitrust Division is, true to its name, really focused on performing a deep dive exclusively into competition or competitive issues. Contrast that with the SEC, for which the Exchange Act charges the SEC to, quote, protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation. Now, certainly nothing in that list is inconsistent with vibrant competition, but fulfilling that mission does require a broader view of the world. Now, at its heart, we are in the game of weighing off any anti-competitive harm from a transaction or strategic conduct with any pro-competitive efficiencies that the transaction or conduct might generate. Typically, harm is measured as consumer welfare, where the consumer, or by changes in consumer welfare, where the consumer is the immediate downstream buyer who isn't always necessarily the end consumer, although we will pay attention to effects on final customers when relevant. In most circumstances, the Antitrust Division is responsible for establishing harm, and the firm or firms under investigation are responsible for establishing efficiencies. These claimed efficiencies vary widely and have varying degrees of credibility depending on the industry. Now, to an outsider, one thing that is noteworthy about equities markets and financial markets in general is that in nearly every discussion, there is absolutely no disagreement about what the relevant efficiency of interest is, namely liquidity that reduces the bid-ask spreads. And that is typically the first thing that people think of when they hear the words efficient market. But foreshadowing a theme that I want to return to, pursuing liquidity at the expense of everything else need not lead to a desirable competitive outcome. Although I am bureaucratically part of the economic policy section, we are not really making policy, but rather enforcing antitrust law. Kind of nerdy policemen and women, really. And in that effort, we generally approach our analyses by taking as given whatever regulations and policies exist in applied institutions. Specifically, merger review is not about industrial policy aimed at identifying what the optimal market structure should be, but the much narrower question of who wins and who loses if the number of suppliers falls from n to n-1. At times, the division will engage in competitive advocacy on a given rule or regulation, but it occurs outside the scope of a given investigation. Now, the mandate of the antitrust agencies is to protect the competitive process, not necessarily individual competitors. Now, this can sound like semantic gibberish, but it conveys an important point. We want to ensure that the rivalrous behavior that boosts consumer welfare remains intense, knowing that sometimes means some market participants may not like the results. This can be quite distinct from a regulatory agency that must, by definition, establish policies by issuing formal orders to achieve its statutory mandate. When a regulatory agency asks a question like, what is the optimal number of financial exchanges, for instance, it goes well beyond the narrow conception of consumer welfare on which antitrust is focused. Wrapped up in that notion of optimal may be goals like systemic stability, fairness, and reasonableness, however defined. So when thinking about concentration, we should keep in mind that a firm that becomes large is not inherently a problem. The potential problem involves how it gets large and what behavior it engages in once it is large. Now, should a firm become big by building a better mousetrap, more power to that firm. If a firm should become big by buying its closest competitor, there is a role for antitrust because the elimination of that rivalry tends to raise price, lower quality, reduce choice, or stifle innovation in a manner that threatens consumer welfare. If a big firm tries to cement its bigness by engaging in certain behavior that deters potential rivals from entering or achieving economies of scale, that too can raise antitrust concerns. So let me conclude with a point of commonality between the work done by staff economists at both the DOJ and across the regulatory agencies. This is a line of work in which seemingly small factual details really matter. When you investigate corporations for a living, you develop a strong sense of humility about your priors. I cannot think of any investigative team of which I've been a member for which our priors going into the investigation perfectly matched our posterior views coming out.
Great, thanks very much, Nate. And I'll come back around because I have a couple of follow-up questions for you. But first, I'd like to go to Tobias. And Tobias, you bring an international perspective to the topic of our panel. What do you see as sources of concentration and fragmentation in today's global financial markets?
Yeah, thanks, Howard. So what I'm going to talk about is going to be very complementary to what Nate talked about, right? So I think from a policy perspective, market power is the traditional view of concentration. What I want to talk about is financial stability. And I would argue that concentration has important financial stability implications. And so I'm going to start with a theme that panelists and the fire chat this morning started, which is about reaching for yield. And as we all know, interest rates have been falling for many decades, but they keep on falling and people keep being surprised by how much they fall. So there's a wedge in many institutions in between return targets and what you can get in the marketplace. Right? And this, you can look that up in annual reports. When you go to insurance companies, to pension funds, to investment managers, they say, this is our return target. And when you then compare that to what you get in the marketplace, there's a big wedge. We do some of that in the Global Financial Stability Report. And what is the response? Well, you have to take on more risk, right? You have to take on more risk in order to fulfill those return targets. And that's what we see globally, right? It's not just a problem in the US, it's a problem globally. European insurance companies, pension funds, banks, Asian insurance companies, pension funds, banks, as well as Americans, they all scramble to meet return targets. And so they go into riskier and more illiquid investment. And so this means high-yield bonds, emerging market bonds, leveraged loans, CLOs, and in fixed income universe, right? And so when you then look at the holdings of those bonds, right? So, and the concentrations of those holdings, it becomes very striking. There is more and more concentration in particular issuers or in particular countries that investment companies, insurance companies are exposed to. So you can document that through public filings. And we, again, do some of that in the Global Financial Stability Report. So I just want to give you some sort of like striking numbers, you know, that is going to make some entertaining chat over dinner. So, you know, so for example, there's one particular country in Asia where life insurers own 18% of US dollar denominated non-US issuer debt, right? So basically when you look at the US dollar corporate market, about half of it is issued by non-US issuers, and 18% of that in the leveraged loan market is owned by a couple of insurance companies of one particular fairly small Asian country. We put that in the Global Financial Stability Report. I don't want to name the country right now. And that happens to be a country where the insurance company sector is not particularly well capitalized. In many countries, of course, insurance companies are much better capitalized today than they were 10 years ago. But in this particular country, it's not, right? Let me give you another example. There is another Asian country where a single bank owns 14% of AAA tranches of CLOs, US CLOs. 14%, one bank. And, this is pretty pervasive. And of course, there are some rules on concentration. So for example, the US Company Act has concentration limits that are, 5% to, at the fund level. But of course, at the investment firm level, there are no limits, right? So it might be that, one of the major asset management complexes might be within the 5 or, sometimes it's a 10% limit in many, many funds, and so might have a very concentrated exposure to a particular emerging market or to a particular high yield bond issuer. There's also concentration in other dimensions. So for example, asset managers have become more concentrated. So the top 20 global asset managers have close to 50% market share, and that keeps increasing. The top 3 consultants to asset management firms, so asset management advisory firms, the top 3 globally have close to a 50% market share, right? Of course, when you go to electronic market making, for example, in the FX market, there are 2 centralized limit order books that have the majority of market making capacity. I think Tara might talk a little bit more about that. And of course, as was mentioned already, in high frequency trading space, it's very difficult to know exactly what market shares are, but say from the October 15th report on the Treasury flash rally, we do know that high frequency trading, principal trading firms have the overwhelming market share in the US Treasury market, as well as in FX markets and some equity markets. And from what we understand, there is a large degree of concentration. And so the point that I want to bring home is that if we had a global recession, and if, say, the corporate sector was hit of advanced economies, the US as well as other advanced economies, right? We would see many institutions around the world being hit in a very similar fashion. And that would have implications on pricing dynamics. And so here it's not so much the point that was made in the previous panel, which is that market makers all behave in the same way. Here it's more the point that investors also have a lot of concentrated exposure. And a lot of it today is to the corporate market. And of course, the flip side of reaching for yield is that as an issuer, you look at market pricing and you say, well, of course I should take on more leverage, right? Given the level of spreads, given the level of yields, and given the level of vol, I should move down the credit rating spectrum. And that's exactly what we see. In investment grade, in high yield markets, there is a movement down in the credit rating spectrum, leverage is going up. And this is fine when times are good, but when a bad shock hits, it can lead to adverse amplification mechanisms.
Great. Thank you very much, Tobias. I'd like to skip over to you, Tara, and one of the things that we've heard from Tobias is that there could be benefits for stability to concentration. I gave some just illustrative market shares in my opening comments. And I guess one of the questions is scale an important driver of sustainable success for certain market participants? What are the drivers of sustainable success for market participants? And how does scale factor into that?
Thank you. By way of background, Virtu is a leading provider of financial services that leverage cutting-edge technology to provide liquidity to the global markets and innovative, transparent solutions to our clients. Scale, this is a very competitive marketplace that we're operating in the equity markets. People compete very aggressively to win every trade on exchange and to win customers' businesses. We're also operating in an environment with very tight spreads, with low volatility, with low volume. And that makes the trading environment, especially for a liquidity provider, pretty challenging. In order to operate successfully in these challenging environments, scale plays a very, very important factor as part of that. You also need to have robust real-time risk management systems. You need to have an ability to commit capital and a willingness to be able to continuously invest in your technology and connectivity to stay competitive. And so scale factors into all of this because you're able to leverage that investment across a number of different businesses. So within Virtu's businesses, we're able to leverage our market-making expertise and investment in technology for our customer market-making business, which provides liquidity to retail-type firms. We're able to leverage that in the agency execution space, where our institutional clients can leverage that investment in technology. We're able to leverage that in analytics and workflow technology tools that we give to those institutional clients to provide more robust transparency around how their orders are being executed. And so all of that factors in. The other important thing to note is that scale is able to be leveraged by smaller market participants. So we've seen a trend recently where you have a lot of smaller or regional players which have very strong investment banking businesses or have very good research businesses but are finding it difficult to compete on the execution space. So increasingly we're seeing firms like that partner with a firm like Virtu who has scale. And so we offer a number of solutions like white label services, which allow them to offer out these advanced algos to their clients so that they can stay competitive in that space, or allow them to leverage routing capabilities that leverage our investment in technology to get to the street and leverage our market structure expertise in how and when to access liquidity. So to answer your question, I think scale plays a very important part in being able to operate in an environment with high fixed costs and an environment where the trade, where there isn't a lot of trading activity going on, and the buy-side commission dollar shrinking.
Okay, thank you very much. Sorry about that. That's very helpful. One follow-up question, to you, Tara, that I think comes naturally out of what you just told us is, how has cost in the industry and how do cost structures affect what we see as the current equity market structural landscape? And how has the mix of participants and trading venues affected how people trade?
So, we're seeing a very healthy and competitive equity market environment, and that can be measured in a number of different ways. So the cost to execute trades is probably at one of its lowest levels ever. Retail, like mom and pops who are trading in the markets, are seeing greater levels of price improvement than ever before. You have tight spreads. I actually have some slides which I'll grab over here. Which has some data that will support some of this. So what we're looking at here, so Virtu has an analytics business that offers us kind of a unique data set. So what we're looking at here is what we call a peer universe of data from 180 plus investment managers in the investment managers globally. And what we're looking at here is the cost to trade globally. And we have it from two different perspectives. So the institutional trading desk perspective will give you a long-term view. So these are going to be larger orders that are at the time that they're handed to the buy-side desk to work. And so that kind of gives us a multi-day perspective. And you'll see that the US has the lowest cost to trade out of anywhere globally. And then we also have a perspective from the broker. So so this really is reflective of what is the broker-dealer's cost of getting those trades done. And you'll see that the US markets are in line with the other markets globally. The other thing that I wanted to, other kind of interesting data that I wanted to point out is sourced from the publicly available 605 numbers. And this is looking at orders that are from 100 shares to 9999, so 9,999 shares. And so this is the amount of price improvement that those orders receive better than the national best bidder offer. And so we're looking at a historic view, and this is primarily sourced from the 5 largest wholesalers of providers of liquidity to retail type firms. And so you'll see that in 2018, that aggregate level of price improvement equaled over $1.6 billion. So that's money that is going back to the end investor when, back in their wallet when they're trying to source liquidity. And they're getting this execution quality in record speed and an efficient, there's immediacy of liquidity, and they're getting all this at the touch of a button. So by all indicators, I think we see that we have a very healthy and competitive market.
Great, thanks very much, Tara. Justin, I'd like to turn to you next. You and your firm spent a lot of time studying venue fragmentation, among other factors in the market. What are the root causes of that fragmentation, and what are the effects on market participants?
Okay, thanks. There's a lot to unpack in that question, so I'll try to do it in a few minutes. I think we could probably have like a graduate seminar on that, but I'll, for everybody's sake in the room, I'll try to boil it down. I think when you look at the fragmentation that we have in the markets today, there have been 2 waves in which those came, in which that came, and both of them can be attributed in large part to regulatory initiatives that had some intended consequences, but many more unintended consequences. Just by way of background, I guess it's helpful to think about what existed before the marketplace that we have today came into being, and that really started about 22 years ago. And before that, since then we've had a big transformation of equity market structure, but before that, it was basically a system in which there were protected monopolies and oligopolies. So if a stock was listed, for example, on the New York Stock Exchange, you traded it on the New York Stock Exchange. NYSE enjoyed 85–90% market share, at some junctures probably closer to 100% market share and very little to no competition. If a stock was not listed on NYSE, and I'm simplifying to some extent here for clarity and time, but that would be an OTC, over-the-counter stock, later known as NASDAQ stocks. And those, before the transformation, were traded in a dealer market, an upstairs dealer market, where basically an oligopoly of dealers were involved in every single transaction, excuse me, and that was a protected marketplace as well, and there was very little competition beyond those dealers. They were involved on one side of every trade. And in that particular market, that was the catalyst for the transformation that we've had, where in the mid-1990s, late 1990s, the dealers in that OTC market were found to be colluding by the Department of Justice to keep the bid-ask spread artificially wide. And there was a settlement. A couple dozen firms paid, I think, close to $1 billion to settle those charges in, I think, 1996 or 1997. And more importantly, there were some rules that came out of that, which tried to make the market more competitive, fairer, more transparent for end investors. And the result of that was the first wave of fragmentation that we saw in US equity markets, where those rules kind of set up tech-enabled startups, both liquidity providers and alternative marketplaces, kind of electronic exchanges or proto-electronic exchanges, to compete with the legacy players in the market who really had a hard time hacking it in the new environment. And then probably about close to 10 years later, as the market participants and the regulators started to cope with this initial wave of fragmentation, we got something called Regulation NMS. And that was implemented, as I said, in part to try to knit together the market that had begun fragmenting. And it succeeded in some ways, but it also led to a lot more fragmentation for a couple of reasons. And the first one, and the main source of the fragmentation coming from Reg NMS, is something called the Order Protection Rule. It's probably the biggest, sort of the centerpiece of Reg NMS. And it basically states in a nutshell that a broker can't trade at a price that is worse than the best price on any exchange. That did a couple of things, and the background that's important to note about that is that this was occurring at a time when the big Wall Street firms that had run the New York Stock Exchange, owned the New York Stock Exchange and the OTC market previously, as a result of that first wave of fragmentation, had been pushing those exchanges and the National Association of Securities Dealers, which ran the OTC market, to modernize, to get more electronic, and ultimately to demutualize and become for-profit, publicly traded companies. And so at the time that Reg NMS came to be, which protected the exchange quotes against trade-throughs by brokers, the brokers also found themselves not owning the exchanges anymore. And it created a situation where they were essentially captive customers of those exchanges. And so that really unleashed a lot of the fragmentation that we see today that people are maybe more familiar with in terms of the dark pools, the off-exchange venues, of which there are dozens, because brokers responded, and this is, I guess, a classic case of unintended consequences. They took advantage of an earlier regulation called Regulation ATS, started a bunch of ATSs that did not have price transparency, and used those as places to divert order flow rather than going to the exchanges and paying the fees, since they were no longer owners, to trade on those exchanges. Reg NMS order protection rule also kind of provides, some people would argue, and I think there's merit to this argument, a subsidy to exchanges, particularly smaller exchanges with low market shares, because every broker needs to, can't trade through the best price on an exchange. They need to connect to every exchange, take the market data from that exchange. And so there's an argument, I think, that some of the smaller exchanges maybe wouldn't exist without that subsidy. And I think it is true from our studies of this for consulting projects that we've done over the years and just the work that we do in market structure. You see the North American markets in Canada and the United States, where there's some version of order protection, they tend to be more fragmented for the market size than other markets where there's exchange competition, such as the European Union or Australia, where you don't have that strict order protection. So those are kind of the two waves and the reasons and the root causes. And before I move on to the effect on market participants, I want to note something I think very important about the second wave that is underappreciated, and that's that there are essentially two sets of rules for stock exchanges and non-exchange venues, off-exchange venues in the United States now. And I think that is an underappreciated root cause of the fragmentation we have today. So if you go back to Reg NMS, it helped create all these dark pools, but then the dark venues, whether they're ATSs or some newer iterations, which are known as single dealer platforms or bank central risk books, which are a little more bilateral in nature, all those off-exchange venues can do things that exchanges cannot. They can very finely segment order flow, give customers very bespoke outcomes and experiences, and exchanges, with certain exceptions, have to sort of treat everybody the same. They're subject to what we call fair access rules. So in order to compete with this proliferation of off-exchange trading, which accounts for about 40% of total US equity volume, the exchanges have to kind of do some weird things. So, instead of operating just one exchange, a company might launch a second and a third and a fourth. And the second and third and fourth will have different fee structures and different order types to try to replicate what a broker can do in one ATS or one single dealer platform off exchange. So that's another very big and I think underappreciated source of fragmentation in today's markets. In terms of the impact, I think, number one, I want to go back to, I think, some of the things that Tara was alluding to with her slides and what Glenn Hutchins talked about in the first session today. The investor has gotten tremendous benefits out of this transformation. When you look at the amount of VIG, essentially, that's been taken out of the system that intermediaries used to get and put in their pockets, that is now going to asset owners. They're sacrificing less of their investment returns to intermediaries. So that, I think, is a pretty unabashed good from a public policy standpoint. It is a more complex market, to be sure, keeping track of these dozens of venues and all the complexity that goes with that. I think the good news is that the bulk or the brunt of the pain associated with that is borne by intermediaries rather than end investors. These are the broker-dealers that have to connect to all of these exchanges and off-exchange venues, have to mind the fee schedules and the order types and everything else. Some of that certainly does extend to the asset management community, and there are conflicts of interest that come with all of these different venues. They have different rules, they have different participants in them, and a lot of times a broker might take advantage of that complexity to put its own interests ahead of those of a customer. So the customer community, particularly in the institutional investment space, needs to be educated somewhat about all of this, but I think that investment of time and effort and resources is well worth it when you juxtapose it with the benefits that asset owners have gotten out of this transformation.
That's really interesting, and I do have a follow-up question, but I think Tobias had a reaction.
Yeah, I just wanted to complement that what Justin said by pointing out that there's also fragmentation across borders, of course, because even when there are global regulatory standards, for example, for OTC derivatives, implementation is often different across borders. And the solution that the fund is supporting and that the SEC, for example, has in place with the Bank of England in the case of CCPs is deference, i.e. is saying that even though the regulatory framework in the US and in the UK is slightly different with regards to CCPs, we are deferring the regulatory oversight over the trades that US firms are doing, say on interest rate derivatives in London to the Bank of England. And so there is a kind of like a regulatory solution to the regulatory fragmentation, at least in the international sphere. But of course, that deference isn't implemented globally. And we sort of like urge governments to improve deference in order to minimize fragmentation across borders.
Tobias, just a quick follow-up to that, just because it's directly on that point. It sounds like you're saying that there will be deference when there's a certain regulatory standard that is recognized, even if not exact regulatory harmonization. How important is regulatory harmonization, and what mechanism might there be to incentivize more countries to meet a standard where they would be able to have the kind of deference that you just described? Because that would seem to have significant benefits for global capital flows.
Yeah, absolutely. I mean, there is, of course, there are the global regulatory bodies. The oversight of those bodies is by the FSB. And in securities markets, IASCO, and for utilities like FMIs and CCPs, etc., CPMI has the oversight. And so these are all organizations where, say, the SEC is a member, and where regulatory standards, minimal standards, are brokered. And so, Dodd-Frank to some extent is actually an implementation of those global standards. And of course, the US has a huge voice in those global regulatory debates. And, but of course, those are only minimum standards, right? I mean, so number one, some countries don't comply with the minimums, but even if you comply with the minimums, the particular way in which those standards are implemented is typically somewhat different across countries. And say, to stick to the case of CCP, say for OTC derivatives, some countries, so the European Union, there's a debate around that, and it's closely linked to the Brexit debate that was mentioned earlier today already. There is a debate about requiring clearing within the Eurozone as opposed to, so there's an explicit push towards fragmentation, and I don't want to go into the motivations for that, but, so deference, I think, is the right answer, but at the same time, there are also other motives that might lead policymakers to lead to further fragmentation.
Tara, did you want to follow up on that?
My follow-up is more on Justin's comments around fragmentation, but I wanted to mention that one of the beauty of Reg NMS and the order protection rule is that it also solves for fragmentation. So you're required to connect to these venues. And so we have this broad connectivity to all of the venues that can be easily accessed through a broker router or through an exchange router. So that kind of solves that fragmentation of venue issue. Brokers have also tried to solve for that through creative and innovative order types. So we've recently seen an increase in usage of conditional orders. The conditional order will allow for algorithms to potentially rest orders in multiple venues to try to source liquidity more efficiently without committing to placing a firm order without the opportunity to be filled. And so the innovation in the market is also trying to solve for the fragmentation of venues as well.
Thank you, Tara. That actually connects nicely to the follow-up question that I wanted to come to Justin with, which is this. You talked about how the fragmentation has, in some ways, brought real benefits, and you've talked about squeezing the intermediaries to the benefit of, you know, the venues on one side, the investors on the other side. To what extent then is the concentration we are seeing amongst those intermediaries, you know, in the broker, you know, in the broker-dealer, broker and market maker space, being driven by that very fragmentation? I mean, is there some sort of inherent logical connection, economic connection between the fragmentation and the venue side and the concentration at the intermediary level?
Yeah, I think there's a very direct link. It's not the only cause, but it's definitely a cause. You know, if you think about the level of fragmentation that we have, and Tara's absolutely right, like the electronic connectivity kind of takes care of this, and there are very large brokers like Virtu that do a great job of that for their customers, so that the customers kind of don't have to worry about it. But there is costs that come with that, right? So connecting to every single exchange in the United States, taking market data from every exchange in the United States, paying the connectivity fees associated with that, investing in the technology that is necessary to be at the fastest speeds so that your customers aren't taken advantage of, adds up to quite a lot at the end of the day. So I think there's definitely a need to be doing business at scale to justify those costs. And that's something that's been around, interestingly, for quite some time. I mean, even though there have continued to be kind of small degree level changes in fragmentation and in the complexity of our market structure in recent years, the general sense that we have a very fragmented market has been well established for a long time. But I don't think the squeeze has been felt as profoundly as it has in, say, the past 4 to 5 years, 6 years. And there are a couple of reasons for that. One, in the earlier stages of the transformation, volumes were going up and tending to only go up. You know, so every year volume would be higher, and in the immediate aftermath of Reg NMS, I think it helped to automate the markets even more than they already were, and that stimulated volume. And then very quickly you had the financial crisis, because I think Reg NMS was implemented in 2007 in stages through 2006 and 2007. And then by 2008, you have, you know, Citigroup trading at $2 and Bank of America trading for $5 and a whole bunch of other stocks that had depreciated so much, and volumes went through the roof. And of course, we, unlike the rest of the world, get paid by the share in the United States. So I think business conditions were pretty good because we had record volumes at that time, and then for a few years they kind of came down, but we're still higher than they are today. And now we've been at this, you know, 6 to 7 billion, 6 to 7.5 billion, depending on when you look at it, type of situation, shares per day, and that's the new normal. It's not the 8 or 9 that you saw. And so I think a lot of firms, whether they're proprietary market makers only or agency brokers or some combination of both, or banks, are finding it a lot more difficult to scale those fixed costs across the lower levels of volume and volatility. And you've seen combinations, right? You know, there have been quite a few, or folks just going out of business, right? There have been high-frequency electronic trading firms, market-making firms that are no longer in existence, or that have merged with others. There have been brokers that have merged. There's others that are deciding to get out of the business, that have been in the business, maybe some owned by foreign banks. I think there was Deutsche Bank recently announced that they're no longer going to be in the U.S. equities electronic trading business. So there's definitely that squeeze going on, and it could be leading to concentration, but It's interesting, at the same time, you see new entrants coming into the market. You see smaller and regional broker-dealers that are getting into the same space to try to compete with Tara and her colleagues at Virtu in algorithmic and electronic order routing. Some non-US bank-owned operators are doing the same thing. So I think it's something that bears watching, but when I think about it from a public policy standpoint, I would much rather let market forces to continue to address the pain that's being felt by intermediaries now, rather than see regulators take any big steps, just cognizant of all of the unintended consequences that got us to this point in the first place. And I think just the final thing I'll say on this is there's a really good example historically of this sort of phenomenon playing out, in which you have an extremely investor-friendly reform that was extremely painful for the brokerage community, and the brokerage community adapted and everything turned out okay, and that was May Day 1975. I was only a few years old then, so I wasn't in the business then, not that old, but I've studied it, and I've even looked at some SEC data from the SEC annual reports. I think it was in like 1980 or 81, and essentially what happened there, for those who aren't familiar, is the NYSE used to have a fixed commission schedule. So every NYSE member firm would have to charge the same commission rates to every single client. And in 1975, Congress said, well, this is kind of silly, we should allow for competition. And in the years after that, firms like Charles Schwab and Muriel Siebert came in and started discounting on commissions, and it was a tremendous benefit for investors, but it was extremely painful for brokers, a lot of which went out of business. Smaller ones merged with larger ones. And when you look at the data, I don't think the SEC collects this data anymore. I'm not sure if they do, but they used to collect data on total commissions, total number of firms, balance sheets of broker-dealers. And if you look at that data, the balance sheets just exploded in the years after that, even as some of the other numbers didn't look so great. So I think the message to take away from all of that, and thinking about this transformation, the benefits to investors, the historical precedents, lead me, and just the fact that unintended consequences are sort of everywhere you look when the government starts to get involved in these markets. I think SP put it perfectly when he said at the outset of the conference that market participants influence outcomes, and in our markets they're very creative and unpredictable. I think all of that leads me to believe that we should probably just let market forces handle the pain on intermediaries.
I'll allow you a quick.
That wasn't a joke.
Let's get a quick reaction from Tobias, but then I want to hear the antitrust perspective on everything Justin just said.
I mean, so, I think there are costs and benefits to regulations, as was mentioned earlier, but, typically there are reasons for regulations, and then there are unintended consequences, and the reasons are, oftentimes manipulation reasons, or competition, or financial stability reasons. So, I do think you have to look at both sides.
So, Nate, you've been listening to all of this with the somewhat different perspective of an antitrust enforcement nerd, as you put it. Having been one of them myself for many years, I like the label and adopt it willingly. But I'm wondering how you think about, from an antitrust perspective, some of these concentration effects that we're seeing amongst broker-dealers, but also more broadly, how does the dynamic between broker-dealers and exchanges look from the antitrust perspective, and how does it compare with other industries that you deal with?
So I think it's worth beginning with what an industrial organization economist might offer as a somewhat simplistic characterization of how these equity markets are organized. And I'll emphasize the word simplistic. So you can think of exchange access as the essential upstream input on which downstream liquidity providers rely, or you can describe the exchanges as a two-sided market bringing together broker-dealers on opposite sides of the trade. I've heard it described both ways. There has been a simultaneous increase in concentration among trading volume among the liquidity providers, while there has simultaneously been a proliferation in the number of exchanges on which that trading can occur. Now, one natural question which has been raised is whether the proliferation of exchanges is causing, or at least contributing to, consolidation among those executing the trades. I want to echo something that Justin was referencing, where I think it's impossible to understand this dynamic unless you ground it in something that is specific to equities markets, namely the combined effect of the SEC's Reg NMS/order protection rule and FINRA's best execution rules that require, or at least are interpreted as requiring, execution at the best available price. Now, this is a regulatory overlay that achieves some really important objectives, but at the same time severely limits customer substitution in a very specific way by giving a particularly outsized role to one dimension of the trade, namely the price of the underlying asset. And to an antitrust practitioner, the ultimate force that disciplines firms to behave in a way that promotes consumer welfare is that of customer substitution. The consumer's ability to credibly walk away from a transaction and substitute to another transaction with a different firm. Now, in most industries, we tend to see rivals attempting to gain market power by differentiating themselves across multiple dimensions. Now, I know that each exchange markets itself by promising a somewhat unique trading experience along some set of criteria, and I'm just not myself informed enough to be able to talk to those specifics. But it's worth recalling that the rules might create a situation in which traders must have what economists call lexicographic preferences, namely where they're prioritizing one feature over all others. And of course, if you are the exchange with that feature when the trade needs to execute, that provides an opportunity to exercise market power. A broker-dealer requiring exchange will still access that exchange, will need to still access that exchange unless it wants to simply not execute the trade, which of course is a terrible way to build and maintain a client base. So customers, in this case the broker-dealers, may not feel able to substitute away from an exchange in two respects. One, they cannot meaningfully substitute away from the best price at any point in time, and they cannot substitute away from maintaining access to the exchange and purchasing that exchange's data feed without risking being unable to execute trades that are demanded by clients in a way that is assured of meeting the SEC and FINRA rules. But here you have market power among the exchanges that may not necessarily be dissipated despite the fragmentation. So normally when we think about fragmentation, we think about it resulting in a customer having many, many choices. And in 17 years of antitrust enforcement, I cannot recall ever having a customer complain that she simply had too many options. But of course, what customers want is not just having choices, but having the freedom over which option they choose. The all-you-can-eat buffet is great. An all-you-can-eat buffet in which you are told in advance that you need to eat everything at the buffet is not a meal that we would necessarily look forward to. And that may be the worry for a customer that needs connectivity of upwards to 14 exchanges. Now let me insert a frank admission. It would be a real stretch to call myself a financial economist, and I am in no way making a grand assertion that these governing rules are not a net positive. But it isn't necessarily heresy to go through the thought exercise of imagining an alternative world where maybe not every stock is traded everywhere, and perhaps some trades are executed at a slightly inferior price at a moment in time, but the transactions fees associated with executing the trade are smaller, or the proprietary data feed required to meaningfully participate on the exchange is significantly cheaper. The competitive process is kind of like a waterbed, and when you push down in one dimension, it necessarily pops up in another. In my experience with other industries, we often observe a slightly different dynamic that does not lead to upstream fragmentation. So when we have an upstream and a downstream firm that has to bargain with each other over various things. So imagine a volume discount like a rebate for trading volume, or an ancillary product like a timely data feed. There is a race to consolidate on both sides. So think, for instance, of content providers and distributors in the cable world. Both sides want to enter their negotiations armed to the hilt, able to inflict the greatest damage on the other should the deal fall apart, a reduction in what bargaining theorists call the rival's disagreement payoff. But we also see a couple of other dynamics that are more expected. So when there is fragmentation in an industry, it is often the result of a technological shock or firms on one side trying to disintermediate the other. Here we have a speed revolution with algorithmic trading, which has been discussed. And we have a situation in which liquidity providers can be incented to disintermediate the exchanges by increasing the amount of off-exchange activity. Another feature that we see is firms engaging in increasingly complex forms of nonlinear pricing, and indeed that seems to be a fair description of some of the rebate policies that have developed among the exchanges.
Can I just respond to a couple of things there quickly?
Sure. Let me give each of the panelists a chance to have a quick reaction to what Nate just said or what any of the other panelists said, but then I'd like to maybe turn to the audience with the remaining time. Thanks.
Sure. So real quickly, there were two things there with respect to the antitrust perspective. One was the effect of fragmentation on execution. One was the effect of fragmentation on the data feed business. And I think there's a much stronger case to be made that substitution is difficult on the data feeds. You know, with respect to execution, liquidity and trading volume is extremely portable from one venue to another. I mean, that's been proven for 20 years of competition, and you know, we already have 40% of the, nearly 40% of the volume in U.S. equity trades that occur off exchanges entirely, quite often at prices that are the same or extremely similar to what's on the exchanges. And I think the largest single market share exchange is NASDAQ at, you know, somewhere in the mid-teens of market share. So there's a lot of migration of execution flow. On the market data argument, I think, you know, if you are electing to compete as a broker-dealer on a certain level in this business, meaning you're say Virtu and you are connected to every single venue, you have a smart order router, you have algorithms that you give to your institutional and other customers, and you have to know every single order in the order book all the way down, that's one thing. But there are other options. You know, so my firm, for instance, does not operate that way. We use best-of-breed algorithmic tools from other firms, so we are not directly paying those costs. And I think, you know, I just want to make the point that not everybody in the industry is captive to that force on market data.
Great. Did anyone else want to take a moment to react?
No, I would just agree that the incremental cost to access new venues isn't that high, but there is a premium associated with getting access to the direct feeds, like a premium, like the supplier, the exchange, is able to dictate what the cost of that is, and that price can be prohibitive to certain market participants. There's a premium associated with that.
Tobias?
I would just make one complementary point, which is that, I mean, we have seen dramatic changes in market structure over the past decade, partially due to regulation, partially due to innovation, and in particular electronification of market making. I think what we don't fully understand is what that means in times of a recession or very adverse developments. So last year we saw two episodes where the VIX spiked above 35, even though sort of like economic fundamentals, you know, were perhaps somewhat deteriorating, but perhaps not as much as the spike in VIX would suggest. And when we talk to market participants, typically market structure, liquidity issues were cited as an amplification mechanism for the spikes in volatility. So, you know, having a close watch on these market liquidity dynamics in the context of evolving market structures, I think is a key policy question.
Thanks very much. I'd like to turn now with the short time we have left and take questions from the audience. And I would, if you would like just to come up to the microphone. And please say who you are before you ask your question. Thank you.
Is it on? Yeah. Jim Allen, CFA Institute. One of the things, I mean, markets have sort of two purposes, right? To be a venue for trading securities, but also for raising capital for issuers. Oftentimes, more recently, of course, a lot of the new offerings on exchanges tend to relate to the trading through ETFs and the like. What kind, and I guess I've heard from one broker-dealer who had explained to me, or a small broker-dealer, regional, saying that the best way to ensure that you get more capital, particularly for small, medium-sized enterprises, is to sort of basically isolate all the trading on one exchange, raise the, put in a fixed commission rate once again. I don't think that that's necessarily the approach that should be taken, but is there any sense of what can be done to sort of solve that solution? It didn't start with NMS, didn't start with Mayday, but is there some way that it can be addressed at this point?
I can take that. So Virtu makes markets in over 25,000 different instruments. We're about 12% of the average daily volume in securities that trade under 100,000 shares a day. We often give price improvement to those trades. So on average, you'll see those trades getting about 2.5 cents per share better than the available quote. And the way that we're able to do that is given our ability to internalize order flow and to not publicly display our quotes out loud. So in some of these illiquid names, there's a lot of impact associated with trading orders in larger size. So our ability to be able to provide size through our internal markets and to have a bilateral workflow, so we know the counterparty of those trades, allows us to step up to provide greater liquidity. I think the SEC actually did a paper on this relatively recently, and I think they found a number of factors contributing to like the illiquidity of some of these names, and a lot of it had to do with index inclusion, the float of the stock, investor interest in the stock, whether research was available on that company. So not necessarily, where is it trading? Is it trading on multiple venues? But a lot specific to the underlying company.
One other idea, I'm not sure if this gets to what you were asking about, but you did mention, I think, something about maximizing the amount of capital raised, and the exchanges are increasingly looking at direct listings. The direct listings that have happened so far did not involve capital raises, but I think both of the exchanges are thinking about ways to make that happen, and that could do away with or minimize what we see often in IPOs where there's a first day pop. The price is here when it's free to trade and somehow goes all the way up here and maybe settles somewhere around here. I think that the direct listing might result in less money being left on the table, so to speak, and more in the issuers, going to the issuer.
Do we have any further questions from the audience? Okay, any last word from the panelists as we close? Okay, well, this does bring us pretty much to our appointed ending time. And I would like to really thank all of the panelists on this panel, but because with the close of this panel, we also close the conference, I would like to thank the SEC for organizing a very insightful and interesting day, and thank all the panelists that have come before the panelists you see here this afternoon. Thank you for coming.